Treasurer Laura Montoya. EFA Secretary Wayne Props. Here. Nick Tejas. Catherine Allen.
Here.
Here.
Don Bigeman. Here. Kelly O'Donnell.
Here.
Alan Sanchez.
Here.
Mike Messina. Kurt Summer.
Yes, here.
Here, Kurt.
And Brent, I'm here. Nick.
You're very faint.
Okay.
7 members present. We have a quorum.
Do I have a motion to approve today's agenda?
So moved.
Second. We have a motion from our in-person chair of our investment committee, Member Bingaman, second from Member Allen. Is there any discussion on the motion? Hearing none, we'll take a roll call vote on the motion to approve today's agenda.
Commissioner Stephanie Garcia Richard.
Yes.
EFA Secretary Wayne Props. Yes. Catherine Allen.
Yes.
Don Bigeman. Yes. Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
Motion passes. 7 voting.
We have a motion to approve the minutes from our March meeting.
So moved.
Okay, we've got a motion from Member Bingaman. Second. And a second from Member Allen. Any discussion on the motion before the council? Hearing none, let's take a roll call vote on a motion to approve the March minutes.
Commissioner Stephanie Garcia Richard.
Yes.
EFA Secretary Wayne Props. Yes. Catherine Allen.
Yes.
Don Bigeman. Yes. Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes. Hey, Brent,
motion
can you
passed.
hear me?
We
Right.
can.
This is Nick.
Okay, Nick, I got you. Nick Tejas, you want
Yes.
to vote on the, okay, so that's 8 in the affirmative.
That will go to agenda item 2A and hear from our State Investment Officer, Mr. Clark.
Thank you, Madam Chair, members of the council. Have brief remarks today. Over the last 12 months, ending in March, our total distributions have been just over $1.5 billion. Our net asset value as of last Friday was $52.4 billion. The New Mexico WTI price for oil is up a little bit over a year ago. It was $82.10 as of last Friday. That's up from $76.83 a year ago. And likewise, our rig count is up a little bit from a year ago to 108 rigs as of last Friday versus 105 a year ago. There are a couple of other things I'd like to mention. So one is, as you know, the council voted last month to expand our role with Mercer. And Amy Rich at Mercer, in the meantime, received a prestigious EEI award for her work to promote diversity, equity, and inclusion in the industry. So I just want to recognize Amy Rich and her great work with Mercer. Second, it is very sad to announce that Nicole Gallegos, who heads up our accounting department, will be retiring. She has been an incredible asset for us. She's been with the SIC for 18 years, and we are very sad to see her retire, but really wish her well. I'd like to, on behalf of the entire staff, wish her well in retirement, and she has just been a joy to work with. So I hope that she experiences a tremendous amount of joy in retirement and occasionally comes by to see us. With that, Madam Chair, I would be happy to answer any questions.
Mr. Clark. Hearing none, let's move to agenda item 2B and hear from Mr. Chris.
Thank you, Madam Chair. Well, the March inflation number came out 2 or 3 weeks ago. It was just a little bit higher than people were expecting, and really has put the Fed on hold. So there's been 3 or 4 statements by Fed governors, including Mr. Powell, about the Fed pretty much being on hold here until we get improvement in the inflation numbers and some of the other things that they look at. They're sort of running out of time for rate cuts this year. So as you recall, at the beginning of the year, the Fed said it might be 3 rate cuts this year. The market took that and ran with it and said, no, it's going to be 6. So far, we've had 0. there's about a 0% chance that they move at their March meeting here, or their April meeting here. June, there's a possibility. July, there's a possibility. But after that, the next meeting's in September, which is very close to the election, and the Fed really, really likes to be quiet in the year of the election, but the closer you get to the election, the quieter they like to be. So we think September's probably off the table. So rates here at 5 1/4 look like they're here for a little bit, unless we see some changes in the numbers. Stock sold off a little bit, about 6%. They're rebounding, it looks like, a little bit today. So we'll see. The market's been really resilient, as has the economy. We look back about between a year and 18 months ago, and closer to 18 months ago, the percentage of the blue chip economists in that indicator, 68% were calling for a recession over the following 12 months. That number, of course, has dwindled down. Not many calling for one today. The difference has been, well, two things. First, the traditional indicators that we look at to sort of gauge inflation possibility is the shape of the yield curve, and if it's inverted, in other words, short rates are higher than long rates, and that's the case now, and it's been the case for more than a year. That's an excellent indicator that the economy will fall into recession within the forward 12 months. The leading indicator index, when it gets down to a certain level, that's a good indicator. In the next 12 months, we'll be in recession. That hit that level about 6 months ago. And so the traditional things that we look at to try to gauge the probability of recession just haven't been working this time. I think ultimately they will, but so far they've been really a non-event. The thing that's held the economy up really has been the labor market. And I had a really interesting conversation with a chief strategist from one of our managers. The manager across all of its funds owns, he told me, 270 companies. And if you take the employment of all those 270 companies, they would be the third largest employer here in the United States behind Amazon and Walmart. So they've got a really good view, and the jobs these people hold are really diversified among these companies. So they've got a really good view into the labor market and into current consumers. So he gets data from these 270 companies twice a month on employment levels, comp, the construction of the jobs, just scattered data from this. And he says there's not a crack to be found. That the labor market is very strong right now, and CEOs of those companies are actually hiring people. So it's gaining a little bit of strength. So really interesting. That's a data point, but a really interesting one. We're still positioned fairly well. We still have lots of cash and bonds on the balance sheet. Risk assets have been fairly flat. So we've had, kind of a -20 in 2022, now +20 in 2023. We're up a little bit this year. The Magnificent 7 has finally cracked. It's down to about the Mag 3 or so, and now in terms of strong performance. So that risk has come down a little bit for us, I think. So I'm not concerned about having the excess cash and bonds. Risk markets are very pricey, and of course they can go higher from here, but I think, particularly on the cash side where we're getting 5 1/4 and we're still 450 plus on the 10-year, a little bit higher than that if you go out into corporate credit space. So we're getting pretty good returns from what are traditionally, our lower returning assets relative to those better returns. So I think we're sitting in a pretty good. With that, Madam Chair, I'll stay up for any questions.
The monthly report on agenda item 2. This is page 18 of your diligence, and this again is a flash, so it's preliminary, does not include updates for private equity, real estate, and some of the real assets. So again, it's a preliminary report. Not much different to say about the economic environment than what Jim said. In January, you had mixed equity returns, and in February, strong equity returns across the board globally. The fixed income markets that reacted to the news of the Fed, and we saw negative returns in the month of February, and for the 2 months for the Bloomberg Ag. Also in February, we saw the yield curve change, and yields went up pretty significantly in February. March, again, as Vince was saying, economic news is pretty good. The labor numbers are good. Corporate earnings have come in good, but they're just hanging over. What will the Fed do? So with that said, I'll take you to page 20 of the preliminary returns for February. And we now have the breakout of the underlying funds. So on the total fund, everything, including external clients, the return for the month was up 1.10%. That was the land grant. You slightly trailed your benchmark for the month, so you can see going across the board for land grant. Good outperformance against the benchmark, especially when you go out more than 3 years. Nice outperformance, pretty flat on a calendar year-to-date basis, but ahead of that benchmark. Same news for the severance tax as well, showing outperformance against that interim benchmark. Again, so looking at I know Vince is going to talk about the target for the severance tax, so you can see the interim targets and the long-term targets for the land grant and the severance tax on the right-hand side of the page towards the top. In making movements there, but holding, as Vince said, more assets in core bonds and in cash. You're getting paid, especially in cash right now for that. But again, moving, as you can move closer to your funding your private assets and getting closer to that target allocation. So, next 2 pages also look at allocations versus their interim and long-term targets. On the last page, or on page 22, you can see the opioid and conservation funds. Opioid is now you can see the same long-term target as early childhood. On page 23, there's just one comment at the very top. This is for the total fund, again, for everything. And then we break it down by the individual permanent funds and then by the external clients. But just pointing out the top for the first 2 months of 2024, looking at your net cash inflow is pretty incredible. Over 2.5, almost $2.6 billion. Strong inflows, and then you also get significant investment gains of almost $640 million. And that translates against that return of 1.24% through February. Page 26 looks at the composites. At the top of the page of the total fund for land grant, the total fund, and then showing land grant and severance. And then we have the underlying asset class composites. U.S. equity, you can see for the short term, trailed as the benchmark for the calendar year by 8 basis points. But outperformed fiscal year to date for the 1 year. And remember, there was a transition in this portfolio. It's on the U.S. equity side, mostly passive at this point. Non-U.S. equity, I know Greg's going to be talking to you about some thoughts for the non-U.S. equity portfolio. You can see strong outperformance across the board there. Public market fixed income, again, strong outperformance against its benchmark. You'll notice the private market, you're building that out, but it's trailing its new benchmark. But also just look at the performance of the private versus the public, and you'll see that it's added value to have that private, even though it's trailed its new benchmark. It's outperforming the public fixed income. And then cash, as Ben said, you're getting about 5.25 on an annual basis for your cash. And with that, on page 27, again, this is preliminary. We don't have marks for the private. Get that on a quarterly basis. So with that, we're happy to answer any questions through February. Questions on the February cash? I have a question. Based on our conversation last month, did you get any of the documentation we're requesting on diversity work about management? That's taking us a little. We're talking to staff and we're putting together reports and going to your managers and getting that information. Give us a couple months for that. But then what we'd like to do is put a sample report by, and we'd like to run it by you to make sure it's what you had in mind. And so we actually met with staff in Portland, and this is one of the topics we talked about. I think it's guilty. Any questions? All right, so we're gonna see if we've got any remarks from our chair of our investment committee before we move to the strategy item.
Thanks, Madam Chair. Yeah, we had a good meeting last week. We did have a quorum for most of the meeting. We reviewed everything on the agenda except for the item 3D, the interim asset allocation target change. So we're seeing that the same time that you are. We did recommend everything unanimously. There was a little bit of concern with the WCP New Cold about some of the use of proceeds of the investment going to cash out some existing investors, but I think ultimately we concluded it was still a really attractive investment despite that. So that's the report.
All right, we'll jump right in then with our first strategy session, 2024 long-term capital market assumptions, and we'll turn it over to Harvey Tam.
Thank you, Madam Chair. Well, you all have seen this report every year for as long as I can remember. It's changed a little bit over time, but we're still trying to make the same points with it. So I think this year, Matthias and I used to kind of tag team this report, but this year he's going to go through the changes in the capital market assumptions, and I'm going to go through the impacts on the portfolio.
Thank you, Madam Chair. Thanks, Vince, for the comments. I'll start you off on page 53, and today we are reviewing the long-term capital market assumptions. This is a part of the process that we go through and provide you any relevant changes on a year-over-year basis, particularly as it relates to implications to asset allocation, long-term asset allocation modeling, as well as your positioning. So these inputs, while they're relatively quantitative in nature, they do have an important purpose, which is setting ongoing asset allocation positioning across all the funds. Page 53, and you recall, you've seen this chart courtesy of your staff in terms of trying to frame up how does today's conversation fit into the broader picture, and you can see in the light blue highlighted boxes where the capital market assumptions as well as the strategic asset allocation fits into the overall decision hierarchy. And at the very top, at the very beginning, everything else really stems and flows from this level of decision making. On page 54, just some high-level philosophy regarding our approach to capital market assumptions, and it's pretty consistent across practitioners. There's lots of reports out there that track the 25 or 30, say, more prominent practitioners that put out capital market expectations, that by and large the directionality of estimates is very much in one direction, year by year. So one thing that you'll notice is that our expectations are always long-term in nature. These are not short-term economic forecasts. We have a long-term time horizon. We think that's appropriate, particularly for long-term perpetual investors. We also have a long-term time horizon. And as you have a large fund with a certain governance structure, I think that's appropriate as you're approving investments and trying to meet a certain allocation over time. Forward-looking, and as I said, they're strategic. They're not tactical. We're not trying to forecast what equities are going to do next week and overweight that and tactical. Saying, here's your objective. If you have long-term return target of 7%, so you're able to meet your distributions to your beneficiaries, what type of asset allocation and can we have that most robustly meets that over a full market cycle, both at up but also in down markets. And these expectations are part of that. It's really part of the recipe. Every set of capital market expectations includes three components. Universal, the first, of course, is return. How much can you expect from each asset class? The second component is the risk, volatility of those returns. That's a fairly common risk measure, although I would say it's not the only risk measure. then the third component is correlation, essentially the interrelationship of asset class pairing and how complementary they are. When you have assets that zig and others that zag, put those together, have overall lower volatility, essentially the concept behind diversification. Put two complementary or multiple complementary aspects together, and they have lower risk than the individual parts. Questions or comments so far?
No, it's the next bullet point I want you to.
Okay, perfect. Yes, our expectations are index-based. So really what we're trying to say is, what can we expect out of the market if we were to passively invest in the U.S. equity market, for example, or in the fixed income market? We're just trying to replicate the overall broad market expectation for any one asset class. We're not saying we're going to pick the very best managers, and that outperformance is what we're hanging our hat on. We're saying if we just invest in the broad market, the S&P 500, Russell 3000 for the equities, for example, as U.S. aggregate fixed income, and receive those returns, what could we expect? If we get outperformance because we're successful collectively picking good managers that provide returns above that, then that's on top. But that's not our baseline. That would just be extra. And our assumptions are, of course, net of fees and all of that. So we try to be very conservative in our baseline to say, if you had passive implementation where possible, what would that be? And then hopefully we can add a little bit on top with some of the manager alpha or outperformance. Because these are long-term assumptions, really 10 to 20 years, the incremental changes that you'll see year over year are minor. You're not going to see our expectations moving up 2 or 3%. That would be pretty disruptive to the portfolio, frankly, over a long time period. It's just not appropriate. There's an expectation of those changes in the market, of course, as the fundamentals and the opportunities that changes, that is considered over that longer time period, not over a 1-year period. That provides a little bit of smoothing.
Madam Chair, can you go more into detail on the assumptions of assuming that there's no investment manager alpha?
Yes, so as I said, our assumptions are just built on the index, on the benchmark. So we're not expecting very strong outperformance from your managers as your baseline, because that is not terribly persistent. In some cases it can be, but can also go the other way, and that would be too aggressive. We'd rather be conservative and say, if you were just passively invested and had everything in index funds were possible, what would the return be? And then our hope is that through your asset class directors and collective work at the structure level, then we can exactly add a little bit, but that's not our baseline. So when we have an expected return, for example, for land grant of around 7%, that would be passive. We hope to do a little better than we talked about, maybe 20, 30 basis points of additional incremental return, but that's not baked into there. So we'd rather surprise on the upside than on the downside, I think.
And focusing on the diversification with the market, will the expected markets be able to get what can get.
Themes on page 56, and overall not too much change year over year. There was a lot of movement throughout the year, particularly in the rate environment, as we've heard, but the beginning and the end point weren't all that different in terms of where the year started and where the year ended. Look at the fixed income space in particular. Yields are a big component of the overall return experience. Fixed income, by and large, remained level. We had, of course, a very strong year in the equity markets, particularly large cap equity, S&P 500 up over 25%. And of course, we're borrowing some return from the future, and that's 25% return year after year. It's a multiple of the long run average. So you'll see our equity assumptions, both for public and for private, ever so slightly lower on a year over year basis because of what I was describing. And your diversifiers, while some movement within some of the underlying components, by and large, when you aggregate it all up, relatively level. So not too much changes in the way of expectations or relative positioning changes. Vince mentioned cash is still not a cash drag that it has been. particularly after inflation with cash flow being quite strong, inflation being persistent but below the cash rate. We have a real yield there. That's one of the relevant changes over time, but we don't expect that to persist indefinitely. So there is an opportunity to continue to look for ways to deploy that cash as it's coming in. Just that there's not a huge hurry perhaps that would have been the case and pushed so many investors into risk assets a number of years ago when we had zero interest rate policy.
Can someone turn on their cell phone or silence it, please, or out there in the space?
And then the inflation number, also very important. We've maintained our inflation expectation at 2.5%. It's not to say there'll be 2.5% next year, but both the Fed target as well as break-even inflation rates are 2 to 2.5%. I think over the full investment horizon that we'll get back to that on average, but we do anticipate that inflation will be elevated for the next couple of years, but it'll come back down for the majority of the investment horizon we have here. Looking at page 61, I'm giving you a very high-level overview on the relevant changes. Lots of detail on the individual assumptions supporting this. It's a very long effort in terms of trying to give it our best estimate of what we can expect out of these asset classes. The other thing I would say is that one of the challenges for developing these assumptions is they have to work as a set. They have to work together. So if you were to have almost looking at it for any one single asset class, that might be slightly different than when you have 25 or 30 asset classes that need to work in aggregate and in a model to give you a reasonable set of outcomes. That's more of a nuance and something that we work through at the very end of our process, what we call triangulation. But it is an important aspect to that overall process. On 61, just a little bit of perspective, particularly on a historical basis, of where expected returns are, both relative to actual returns that were earned in those asset classes, that's at the top part, and then relative to where we've expected those returns to be historically. So to give you a sense of where those asset class expectations fall on a historical basis. You can see that still it's moved off at the bottom end, but still would say below long-run averages, and in part because we've had a pretty strong run, and particularly in a lot of the risk assets, valuations are quite high across a number of assets. It's not to say we won't get good returns, it's just we may not get the same level of returns that we've enjoyed in the past decade. In terms of expected returns down below on the second half of that page on the bottom, you'll see that fixed income has moved up relative to where fixed income expectations have been for the last 10 or 15 years, and that's just a byproduct of where rates have gone. Rates are certainly a lot higher than they were a number of years ago, so that's reflected of part of that. Equities still attractive overall, but valuation certainly not at a point where you say we need to go all in on this. Then 62, this is our expectations along with the volatility or the distribution of outcomes around that. You'll see that some of the asset classes that have the highest expected returns, so that's the dark circle further to the right, that is the higher the expected return. The byproduct of that, though, is wider bar, so essentially saying the outcome of returns or the uncertainty with that return greater, and so the underlying rationale behind the concept, you have to take on risk for the opportunity to earn return. We know that, and that's where the asset allocation mix comes from, trying to get that balance right. So
there is no risk access on these graphs, and I'm wondering if you can kind of substitute the length of the bar for risk.
So that is the length of the bar, is the risk. That's exactly right. So for example, the equities and emerging markets the blue bars, higher prospective return, but also higher risk associated with that, which is why the bars are broader. You have more upside, but also a lot more downside. Within fixed income, the green section, you notice that the circles aren't that inspiring. They're not that high, but you also have very little chance of negative returns here, and the certainty of outcome is much greater. That bar is much shorter. So that's essentially the trade-off. You have lower return but greater certainty of outcome. You would like higher return than you might have more uncertainty of outcome.
Just a question, when you're looking at risk, do you have a process that looks at low probability but high impact kinds of incidents that may occur? And again, I'm thinking current day Iran, and so there's a war escalates in the Middle East, and also China overtaking Taiwan, which would impact the chip market or others. So how do you do that? How do you look at something like that type of risk?
Yeah, a couple different ways. One of the ways, a lot of the risks that you're describing, to the degree that they're factored into the fundamentals, are incorporated into our estimates because it's data-driven. But then on the back end, the Monte Carlo is really where a lot of the stress testing comes from, where you say, what are the outliers and how bad could things get in those kinds of shock environments. It's a combination. We don't, obviously, it's difficult to say. We wouldn't make a change to our expectations based on the election later this year. We don't have any greater insight to that than anybody else. As that information comes through and is worked through the market, that's reflected. But we don't make big bets on things like that. We try to stress test it, as I said, through those two mechanisms. On the next page, page 63, this shows our expected compound return. Compound return is an important number to look at. The compound return is different from your arithmetic return in that it factors in the volatility risk, so essentially the return that you would earn over time, and likely the more relevant return number between the two. So these are ordered from highest to lowest. And the dashed orange line represents the 7% return target that you have for Land-Grant and some of the other funds. You can see that although not many, there are a number of asset classes that are actually expected to earn above the 7%. A number of years ago, that wasn't the case, and that changes from time over time. So it's important to kind of keep that in mind. Of course, again, through diversification, combining some asset classes that are complementary, can move the overall portfolio return up for Land-Grant and the like. But it is important to keep in mind how realistic is it for target, and if you notice that you're consistently falling below that, that might necessitate a conversation.
Trying to get into the Mexico SIC meeting.
Excuse me, someone needs to mute their phone, please.
And on the right-hand side of this chart, you can see a lot of green. Again, those are your traditional fixed income sectors. They've moved up as rates have moved up. Certainly a lot better than they were even a short period ago, a number of years ago, but still on the more conservative end, but certainly more attractive on a relative basis than perhaps they had been in the past. Page 65, this is the capital market line. It shows how the line has changed on a year-over-year basis. Importantly, one of the things that I look at here is the slope of the line and how steep it is or how flat it is. That ties directly into the efficient portfolios and the efficient frontier as part of the mean variance optimization and modeling. And the line is more flat, essentially means that you're not likely getting properly compensated for placing additional dollars into risk assets, conversely, the steep, more attractive environment to risk assets. And so in this case, you can see, while it hasn't moved a lot, the line has flattened out a little bit. The yellow dashed line is 2023. The blue solid line is 2024. And then finally, on page 67, this is the the aggregate inputs for all of the asset classes that we've developed. You'll notice some of the changes in here are the restructure of the fixed income portfolio that has been incorporated. Anytime you're making changes at the structure level, we incorporate that into our modeling and into the process. Tend to have fairly high level asset class buckets. We're not making structure decisions here, so we're not trying to decide between how much in large cap and how much in small cap equities. It's really talking about how much are we putting into the various building blocks, and then having greater discussions at the asset class level through the use of structure studies on what is the optimal way to incorporate and build out those individual programs. And you can see the 2023 numbers, the 2024 numbers, and then the changes on the far right-hand side. Overall, particularly on a relative basis compared to prior years, not much in the way of movement. The public equities, or equities in general, they probably expand that comment even to say the risk assets, by and large, slightly down, fixed income, pretty stable, cash has moved up, and some of the diversifiers flat to slightly up. So portfolio, when you put it all together, I think Vince will cover this in just a moment. Not a lot of change in terms of expected return or in terms of optimal. So thanks for the time. Happy to take any questions or comments.
So before we move to Mr. Smith, any final questions for Mr. And were we joined by Member Messina? Are you on? All right, Mr. Smith.
Thank you, Madam Chair. Well, let's jump to page 96, and we'll land there just for a second while I say that we've got a description here of each of the funds to kind of lay things out for you. And then, and you don't need to go there, but page 130 has statutory language for each. So we've got the description and then some backup on the statutory. So let's start, if we could, on page 98. And this is all of the funds that we manage here. This is the first time we've presented this information in this manner. So it's all of the funds, and they're lined up by their focus. So on the far left here, you see the higher growth funds, and on the right side, you see the stability focus fund, like the TSR and the tobacco fund. So they're lined up by risk. So higher risk on the left side, lower risk on the right side. And then all of the information, so the distribution rates, target returns where we have them, and then the asset allocations below that, and then the expected returns and volatilities, so forth, in this table. So just thought you might be interested in kind of seeing it on a risk scale, how these funds are lined up. If you go to the next page, I just wanted to point out a couple of things. This is the Monte Carlo that Matthias is talking about, and they run this just a statistical math model that they run to what sort of possibilities of return paths could happen over specific periods of time. So this table has return periods for 1 year, 3, 5, and 10. I have you focus on the 10. That's what we sort of care about the most. You can see from the 10 years here, and all of the funds are listed here by their asset allocation. There's not much chance of losing money over the 10-year period. Now, the inflation assumption is 2.5, so there's a little bit of a chance, that maybe 15% or so, that we could get below inflation and lose purchasing power. But over a 10-year period, on a compound basis, very little chance from even the highest growth funds of losing any money. Only a pretty small chance of losing in real terms in terms of purchasing power. And particularly the TSR, we keep that pretty safe, so there's very, very low chance that fund could lose any money over 10 years. A pretty good chance that it beats inflation over this time frame. So I think we're positioned pretty well for even rough mortgage over, if you look at over 10-year type period.
And back on 98, those allocation numbers are where we're at, or our targets?
Those are our targets. Right. Yeah. And then I wanted to maybe touch on a question that Kathy had asked about how do you account for certain risks, like a war or something like that. When those big things happen, it's usually done over over a 3-year period, right? So even if you think of 08, 09, markets had recovered by mid-2012 almost. So when we get those even big dislocations like 08, 09, 3 or 4 years, we're usually back to where we were in the stock market. So the way we battle those shorter term things is really the diversification in the portfolio. So owner index stocks, bonds, real estate, and so forth, primarily how we do it. And this table shows that. You can see big volatility in the 1 year. So a 5% chance of a 12% loss in our highest risk fund. But when we go to the 10-year, you can see there's just about no chance of a loss. It comes back over the longer period of time. So let's flip to 103. This is
Madam Chair, on that graph on page 99, is that net fees?
Yes, it's assuming we invested in the benchmark, so there's no active in it. So let's discuss 103. This is kind of the meat of the information here. So this is the asset allocation of land grant and conservation legacy. They happen to have they both happen to have the same allocation. That's on the far right column. That's the target allocation. We're away from that now on an actual. But the things I wanted to point out to you here is we've got a very good mix of assets, and these assets we use in just about all the portfolios. So some on the less risky end don't use some of the equity, but we've got a good mix of assets. Classes, Matthias was talking about that a little bit earlier. Look out at that far right column and get down to that second section. 76% of our assets are considered capital appreciation, so it's very much growth orientation. Drop down to the next section, that last line, expected compound return 7% for this fund. Land grant has a 7% target compound space. So very much growth-oriented funds. Not much change in the expected return from last year. As Matthias showed you in that prior table, there's not much change in their assumptions. So that translates into not much change in our expectations. But a good solid asset mix. I wouldn't point one thing out that we'll see later on here. The equity component of these two funds is 55%. As we talked in previous meetings at asset allocation time, we think over the very long run for these growth-oriented funds, 60 to 65% equity is where, over a very long period of time we would shoot for. So we're a little bit low there. I think that's a good thing, given valuations, and we're diversified into some of these other asset classes, which, as you saw earlier, have almost the same expected return as stocks do. But we can own a different type of asset and still get a similar return profile. So that's land grant. If you flip to 106, that'll be severance. The only difference I want to point out here is in the private equity structure. So we've got the in-state private equity program at 9%. This is the only fund that those assets are in. We fund that primarily from private equity, national private equity. So that's a 15% target in land grant, 10% target here in severance tax, and a percentage point out of 1 percentage point out of the fixed income. Land grant 6, this one's 5, and then the rest come from the return real estate area. So all of those asset classes, we have a higher expected rate of return than we do for the in-state PE program. That's why you see when you get down to the third section, a 6.6% expected rate of return from severance tax. So about 40 basis points per year compounded, lower expectation for severance tax. The target there for severance tax is 6.75. So we may want to revisit that, sometime in the future. But that's the main differences for severance tax. 109 will show you water and rural libraries. The primary reason I wanted to show you this one is look at the equity exposure in these two portfolios. So 15 each on broad U.S. equity and international equity, 25 on private equity. That's 20 and 20, on land grant, and 15 for private equity. So a much closer 50-50 split. I think that's a little more optimal. So in land grant, we've about 75% of our equity exposure is publicly traded market. Only about 60% here. So a little more diversified, and among those two equity portfolios, the equity portfolio that water and rural libraries own has a slightly higher rate of return, expected rate of return. Total rate of return, though, for these two funds is 7%. That's in line with the land grant, and puts them out on the growth end. And Madam Chair, that's the comments I have on these. There's just a ton of information in there that we just try to wade through. So we'll take any questions.
Can you remind me the reasoning behind putting the Land of Enchantment Legacy Fund allocation percentages the same as land grant?
It has a growth profile to it, so it's a fund that based on the distribution and the size of the fund that we can put it in growth mode and try to grow as quickly as we can.
So it's a little bit more like aggressive kind of?
Yeah, it's a little more aggressive allocation. The other thing is the fund's pretty small, so so we have sort of some natural liquidity with the much bigger funds that own the same assets. So if we need to sell private equity, land grants and average tax are almost always in the 1.5, right? So we got some liquidity for that fund that we don't necessarily have for say land grants.
And then we do these capital market assumption strategy studies every 3 or 1?
Every 3.
3.
And we're coming up. I think we're coming up next spring for one of those.
I remember last year we did the asset allocation. It was my second meeting. I'll never forget that. It was a big crash course for me. So these are the asset allocations that we're wanting, but we're not quite there. How much do we have in cash versus how much is already allocated but in cash?
Well, total cash would be in your performance report, right, Marcia?
Yeah, I think, I didn't see the full page of it, so I was trying to add.
It's around 7, maybe 6.8.
Okay. So it was about 8 or 9 last month, but then we didn't factor in what was already allocated, but just in cash waiting for the allocation to go through.
No, that's inclusive of everything.
That is inclusive. So we're about at 6.8 in just cash.
7.
Right. As of February, I'm looking at the cash equivalent is $5 million.
$5 billion.
$5 billion, sorry.
I think we're a little higher. I think we're a little higher than that. I'll look.
Okay. Well, and the $5 billion or the $7 billion, wherever we might be, that includes what is already going to be allocated that they haven't drawn from it, or is this additional cash that needs to actually be approved by the council?
So we've got cash. So that cash number is what we hold all total across all funds. So as capital calls come in every month, it's usually a net out. So we're getting capital drawn. We fund it with that cash, and if we look at each fund's allocation, and so say we get a $10 million call for private equity, we'll look to see which one of the funds is sort of lowest on private equity allocation. If they've got cash up to that $10 million, or up to the next one, yeah.
This was in February, so maybe. Yeah, right. Flag. And then I forgot to ask this question when you were presenting, but you were also interested in looking at fees and analysis of those fees. Is that something you all talked about in Oregon as well, or are we moving forward on that? I think for me, my concern is not only what are the fees, because the council really doesn't see, but what we approve. And then when we approve it, based on what they're saying the rate of return is going to be, are we really getting to that point years down the road? Because I don't know if anyone, maybe staff is solidifying that what they've presented to us is what they actually receive, they earn. But on our end, we don't quite know. So when we do a re-up, we're not clear on whether or not previous times they had those earnings. So I was hoping somebody was talking about some type of presentation or analysis on our fee
how much we're paying on the back end. Did that move over from last month?
We haven't discussed it, we'll get together.
But it needs to be, yeah, we'll work on the public and then, work with your specialty consultant.
So I think it's twofold. One is when they're coming before us, especially if it's a relationship we've already had, do they meet the standard of what they said they would? Or, did they fall short? Did they go above it? Sometimes we do see that on our presentation. And then the other one is the overall analysis of who we've worked with, what we've paid both on the front end and the back end, minus what we are earning. Did we really get to that point of where they said the IRR was going to be? I want us to be able to see we're taking more risk. We need to make sure the bottom line is still showing a positive for us. That's sort of where I'm trying to go with the end result. And I know it's a little bit more complicated to do that, and it probably would be by each portfolio or each type of asset. It's always easier, but it's something we really do need to look at and talk about and make sure that we're making these decisions that we're being fair on that end too.
Isn't that something you all do as part of due diligence, though? I would imagine that if we're looking at a RIA, those numbers have already been run. Is that not the case?
We do it on the RIA for sure, because I know you guys have presented it. But overall, when you're looking at the school portfolio, we don't have an end all of this is what they said this is going to be what the earnings were, and this is what we actually ended up positive or negative indifferent. That part we as a council don't have.
Generally, it's not addressed exactly like you're guessing. And I think it can be. But if you look, say, at the private equity performance report, we'll show you how the portfolio is performing by vintage year. So you'll be able to see at the portfolio level, were we in the top quartile or second quartile, or how did it come? We also compare, get in the private equity, and also in the real estate return, compare it to the public markets. So we take the cash flows that happen in private equity, and we sort of flow it in and out of the S&P 500, well, Russell 3000, and show you what that IRR is. That's a regular page in those quarterly reports. So we come at it a little bit differently, but I don't think it can't be done.
I'm wondering if is it possible to make a note to yourself, I don't know how this would work, draw our attention to specifically those slides when you're going through the individual asset classes. And then remember on your private, those are all, the performance you're seeing is net of fees. So are you wanting to see it, and right, they're all net of fees when you see those?
Yeah, well, that's great for the presentation for us, at that moment. But overall, if we're looking as a council at the full picture, even what you're talking about, you're looking at the whole. But let's say you have 3 duds in there, because you sometimes do, and then we do a re-up on them. What's the point if they're not pulling the slack and we're paying them a lot on fees? So that's where I want to go into the bucket and see who is performing where they said they were performing and earned what they should have based on that performance versus who said they were going to do it and then they didn't perform where they should have, but yet they got a lot on the fee side. Especially because lately I've been noticing that we're putting a lot of skin in the game and a lot of them are not. And that concerns me too. So if we're going to put skin in the game before they do, then I want to make sure that we're holding them accountable on the back end. And I know that's pretty complicated, especially when you're looking at each different asset class, because they all run very differently on fees. So I don't know if it's based on portfolio or based on the asset class itself, but there's something that we need to do to be better on it, because we're already at $54 billion. It's only going to get bigger, and the more information we have, the better we can make our decisions on what we need to do and what we don't.
The asset class directors are the ones who know.
So that's it, Madam Chair, unless there's further questions.
Further questions? Decided that. Move on, to our second strategy session, the blackout analysis by, Mr. Kutzman.
So with Macau Custom Stable, Madam Chair, this is an analysis we started several years ago, 2014 or 15. I think we started with 15 peers of ours. We've more than doubled that size. And the purpose here is really just to show you how land grant and severance, I think we have early childhood in there too, how those funds are positioned relative to other large successful public funds.
Thank you, Vince. Thank you, Madam Chair. The presentation begins on page 135 of your diligence materials. Just a quick reminder, as Vince mentioned, we've been doing this analysis for the past 9 years. Currently, we are looking at 35 large public institutions. Those 35 include 2 of our peers in the state of New Mexico, a couple of sovereign wealth funds, and very large U.S. pension plans. The median assets under management for those is about $56 billion. And the type of data that we collect includes, but is not limited to, things like policy and target asset allocation, trailing 1-year returns, fiscal health, and some other high-level indicators. So the data is collected from the annual financial reports, and the data that is presented in this chart that you will see is from 2023 annual financial reports for those peers, for our peers. The output of the analysis begins on page 138, so let's take a look at that. In a nutshell, so what do we see here? The green line is the efficient frontier. The efficient frontier is a set of optimal portfolios on a risk-adjusted return basis, which is, of course, subject to the model constraints. The portfolios that are above the green line are deemed to be unattainable. Portfolios below are called suboptimal, which means that for every single portfolio below the green line, you can get either a higher return for the same level of risk, or you can get a lower level of risk for the same exact return. That's why they're called suboptimal. The colored diamond shapes are 3 of our permanent funds, land grant, early childhood, and severance tax. The orange dot is the representation of the average portfolio of those 35 years. 70-30 yellow square is just a hypothetical 70% public equity and 30% public fixed income portfolio. And what we did a little bit different this year, we included the purple diamond shape. This is the 2019 land grant permanent fund actual allocation. So bear in mind that the asset allocation for all of these peer institutions and ours are the target asset allocation. But we just wanted to show you how our asset allocation change resulted in the move along the efficient frontier over the last 5 years. That's why we included the 2019 actual asset allocation. So just one thing that I wanted to note also is that one factor that defines the position of each dot is primarily the asset allocation. So we have on the y-axis the geometric return. The set of assumptions that we apply to calculate that comes from the long-term capital market assumptions that have just been presented. The risk numbers are either the asset class correlation or the historical volatility. So that's the same number of assumptions that we apply to different asset allocations, and that defines the position of all those dots that you see on the chart. Having said that, you can see that the land grant permanent fund is located in the upper right-hand corner. So it is one of the most efficiently allocated portfolios out there. It has a certain level of risk, but at the same time, we are pretty well compensated for the level of risk that we are taking in this portfolio. The early childhood is a little bit more of a defensive portfolio. It has a higher allocation to public fixed income and a lower allocation to risk assets. So hence, it's positioned a little bit to the lower left from land grant, but nonetheless, it's really close to the efficient frontier here, and it's also very efficiently allocated. Severance tax, Vince has just addressed that. It has, I think it's about 9% allocated to the in-state private equity program. So it's a pretty split. I didn't write that. But yeah, this is why it's positioned a little bit closer to the cluster, but again, nonetheless, it's very well allocated and positioned at the top right-hand corner of the main cluster of those black dots. So overall, our portfolios are very efficiently allocated compared to its peers. We are well compensated for the level of risk that we are taking. And having said that, there are a couple of items that we would like you to note. One of them is that most of those dots are the public pension plans. They have a different asset liability profile. So
Yes, aggressively.
exactly, they can be this aggressive. They have to be a little bit more defensive. They can be as flexible from the investment standpoint of view, and they also have the mandate that preclude them from investing in certain areas that we are allowed to invest in. And number two is the time to change the asset allocation. So that's also very important. Of course, it's not publicly available information, but from the data, from the sample that I was able to dig out, on average, it takes anywhere from 9 to 13 months from the time that the asset allocation decision change has been made to the actual implementation, to actually get, that working. So we also have to take that into account. We are at an advantage right here because we move things a lot quicker than that, but this is...
What is the time frame for us when we make an asset allocation change to when it would show up?
For us, it's anywhere between, I would say, like 4 to 6 months. So we are about half that. But once again, this is a small sample. I was able to get it from 7 funds. Of course, we are looking at 35, so it's not really indicative. I can also speak about my previous employer, the CalPERS. It takes them a lot longer, especially when it is about the private asset classes. I remember when I joined in 2018, they were talking about increasing allocation to private equity. They actually got it implemented when I was already in New Mexico in the middle of 2021. So it's really a bullet point, that we have to take into account, as well as that asset liability profile.
Madam Chair, so for example, land grant, change the asset allocation and increase private equity significantly. I thought we hadn't gotten there yet at that point because we did increase it so higher. We still have, that's why we have an interim target out there. Right?
So we were at 13%, and we raised it to 15%, and we got huge inflows. That pushed us down about 11. That's why we got it.
There was a different fund that we changed it pretty significantly. I can't remember which one it is, but I know we're not close to that percentage, correct?
Right. Early childhood was the fund, and when we initially got the money in, we invested it pretty conservatively until we had a chance to talk with the council. And
It's $2.1 billion.
and figure out should this thing be in growth. But early childhood looks a lot like severance tax. So used to basically no inflows. We're not projecting inflows past the next couple of years. So we invested it pretty similarly to severance tax. But we set the long-term allocation to be where we think this fund should be ultimately. And yeah, that had a few big jumps in allocation, and then we got the big inflows that came in. That frustrated us a little bit there into setting those allocations as high as we did. So yeah, we've got interims there, and we are a little bit away.
So in this, when we're doing our interim asset allocation, it's for all of them?
Most of the funds have an interim. I think how we have 3 or 4 that are invested to their long-term targets, the smaller funds.
Yeah, 4 invested long-term targets. And
It'll be interesting to see where it's nice to see the actual land grants for 2019. Interesting to see where the actual early childhood.
Okay, yeah, we can include those.
So as far as for early childhood, I know we're not at 9 to 13 months. We've already passed the 13 months. So how does that tie in? It's just the assumption is based on everything with an average.
That's just average out, okay. Yeah. So, yeah.
Okay, thank you.
Again, for the public asset classes, it would be a lot faster for all those peers, but for the private, it would take a lot longer. Yeah, I guess with that, I'll pass it on to RDK for further comments if they have any.
Just a couple comments. I think a lot of those pension plans and a lot of those very touched on, which they had inflows coming in. So, what this says is frustrating, and it really was wonderful to get those
Good, well, it was good news. It's what we call a high-class problem. So, with that said, we're going to make a couple of comments about, underlying. If you go to page 139, we talked today a lot about risk assets, and you moved to more risk assets last year with your asset allocation. So on page 139, you can see this universe of the other 4 funds and the other 35 funds, and we put the range of risk assets. That's the second column or the first that shows a bar chart. For the most part, your funds fall in the ranges of these other public funds. For risk assets, you can see that the land grant falls slightly at the top. Again, these other funds don't have the inflows that you have. They have pension, a lot of them have pension obligations, so you increase your risk assets, and you're above median. Now, the median in this group was 81% of the assets were in risk assets. Land grant was at 94%, and as Mikhail said, early childhood is a little more conservative and has 87% in risk assets. Traditional assets, on the far right-hand side, the median of this universe that was put together of traditional assets, that would be public equity, public fixed income. The median is 58 and 46 for land grant and 53 for early childhood. So you look a little bit different, but you look very similar. You just have more risk assets, and there's a reason why. Again, the inflows. The next page looks at U.S., international, and global. You don't have a global allocation. You do have around the median, slightly above median to U.S. A lot of these funds still have what's called a home country bias, that they put their public equity more in the U.S. than outside the U.S. You did more of a 50-50. So that's explanation of that page. Page 41 looks at your core and non-core. Remember, we're looking at other funds, so we're still grouping it for this analysis as core, non-core, where you are public fixed income and then private fixed income. And your public fixed income is what came down to fund a lot of the more risk assets. So your median, you're well below median in your public fixed income, above in your private fixed income. And lastly, on page 142 is looking at this universe and the allocations to alternative asset classes. Again, no surprises there. You have those are risk assets. You have higher allocations than the median of this universe. Again, much of this universe is tied to not getting, they don't get contributions like you do. And currently, you have no allocations at the right-hand side to groupings, absolute return, hedge funds, and risk parity. Otherwise, you're within the range, but at the high end of the range. Remind me what the difference is between global equity and international equity. Global includes U.S., so it's global. All right. So international is just X. It's just ex-U.S. And that's with that. We'll take any questions with Kyle on Blacktop. Spectacular. All right, thank you all. We're going to go to our first vote of the meeting, agenda item 3D, interim asset allocation target changes, and we'll go to Mr.
Thank you, Madam Chair. Page 145 is the first page of a 2-page memo, but the information is all on the second page, so 146. What we're suggesting here is a change to the severance taxes interim target for private equity and core fixed income. We set these interims along with several other funds back in June of 2023 because we were making so many changes and also wanted to suspend upper and lower limits on core fixed income for several funds. We came to the council for a vote at that time, and you no changes to any of the funds in that interim, to their interim targets. But we're still pretty low on private equity relative to the interim target. So it's about 2/3 of the way down the page, the line private equity. If you go to the middle column, you'll see a 12% target. Go over to the far right, you'll see that we have an actual of 3.4%. That's mostly a function of the inflows that happened to the severance tax from last year until now. They've just been huge. And so it really made our forecast of being able to get to 12% in a year or so, pretty aggressive. So I think we need to raise it to 7% or lower it to 7%. I think it's quite possible to get there in a year from 3.5, and put that excess, that 5 percentage points up in core fixed income. That's where the money is right now. So pretty easy change here. I also changed or suggested we change the upper and lower limits. So from 7 dropping to 4 on the lower limit, and at 10 dropping from 17. All that's detailed in that fourth box.
Why does it say suspend on the upper and lower limits for?
So we had so much capital come in, and we knew it was going to go to cash and fixed income. We just could not get it in the public, or the private market, private asset market that quick. So we just didn't know what those needed to be. We could have set them out super wide. They would have meant nothing. But we thought just spending it was the best move, because we just didn't know where they would be.
What do you mean by?
They're just suspended. There is no upper or lower with it.
There's a target.
But we do have targets.
Right now we're voting to increase the target from.
Yeah, that's just where the money's sitting right now. The actual funds are sitting in core fixed income.
So based on the recommendation of the SIC staff, I move that the State Investment Council authorize an interim asset allocation target change as discussed by the council and memorialized on page 146 of the SIC packet. Second. Okay, we've got a proper motion by the treasurer, second by member Allen, and discussion on the motion for the council.
And I don't know if we had member Messina join us, but.
I'll call his name, just to be careful.
All right, so we can take a roll call vote on the asset allocation. Interim.
Commissioner Stephanie Garcia Richards,
Yes.
Treasurer Laura Montoya,
Yes.
CSA Secretary Wayne Props, Nick Hayes,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Mike Messina, Kurt Summer.
Yes.
That's 9 in the affirmative. Motion passes.
We'll move to agenda item 3E, our international equity structure study, and this is everyone except you.
Hi, everybody. I'm Greg Dunn. I'm the new Director of Public Equity. And this is Matt Sturgeon with RBK. So he's the consultant that works most closely with us on the equity side of things. So today what we're bringing to you is a structure study for international equity, so ex-US. So this is something we do every 3 years. And it's been about 3 years since it's been done. So this is something that Starla was working on.
I'm sorry. You just started in SIC?
2 months ago, yes.
Oh, great. We've never seen you, so can you talk a little bit about yourself first?
Oh, sure, yeah. Yeah, so I was introduced very briefly at the meeting 2 months ago, my first meeting. But so I've been in the finance industry about 25 years. I grew up in Denver, went to Colorado State for my undergrad, went to Duke for my graduate degree. And for about 20 years, I worked at Thornburg Investment Management. So I was a portfolio manager up there, and I oversaw domestic equities and international equities portfolios for Thornburg for a long time. I stepped away from that about 3 years ago, and for a few years kind of became a stay-at-home dad and thought about what I wanted to do next, and wasn't really looking for a new position necessarily, but this kind of hit my radar. I sent in a letter and a resume to Vince, and we started having some conversations and interviewed with him and some other staff members. I was honestly pretty excited to step into a role like this, where I think my experience in the public markets as an investor helped me be a good manager of managers for the SIC. And it's pretty exciting, the assets that we have here and the benefits that it can have for the state of New Mexico and the people of New Mexico. As I said, I've lived here 22, 23 years. I love it, and I don't think I'll be leaving anytime soon, especially because my wife is a Santa Fe native, multi-generationally, and so we are very tied to Santa Fe and New Mexico. I'm happy to be a part of this.
Well, welcome. You're happy to have you.
Yeah, and I'll say great without wasting time. I get to know the portfolio and having the structure, which is a result.
Yeah. So what I'm going to do is, we've got the memo on 147, and then we have a slide deck with a lot of supporting material. And my plan is to, I'm not going to take you through every single slide, so I'm going to jump through a few different slides and give you the broad overview. I'm happy to answer any questions, address any of the specific slides that maybe I don't touch on directly. But before I get started, one thing I wanted to do was give a little background on our process and also define a few key terms before we have the discussion. So slide 151, this is Don's famous process flow chart. You'll be seeing this pop up again and again, I think, as time goes on. So I think it's really useful to show, where, in this case, where does the structure study fit in the process of what we're doing? So I've highlighted the bottom 3 squares there. So today is the structure study for the ex-US public equity portfolio. We're not recommending any new managers. This is simply looking at the structure and asking for approval for our recommendations around the structure. Then going forward, we step into the portfolio building and manager search due diligence process. That only gives 1 square, but that is a big chunk of how we spend our time as staff of the SIC. So we'll be going through a public RFP process, requesting proposals from public international equity managers, going through a screening process of the investable universe, and with the help of RBK, narrowing down to what we believe are the managers that best fulfill our fiduciary duty to identify and invest with managers we believe provide the best possible risk-return outcome and give us the exposure to those asset classes as defined by our structure study. So then that's manager selection, that feeds into actual performance reporting, everything else in this process flowchart. Next slide, a couple of key terms. So you hear us often talk about, especially in these public equity portfolios, tracking error, beta, and alpha are 3 of the key terms that you'll hear often. So beta is a measure of a portfolio's expected move relative to movements in the benchmark. So a beta of 1 is the market. think about this in terms of, say, if you're using your benchmark as the S&P 500, as an active manager, if you have a beta of 1.2, that would give you an expectation that if the S&P goes up 10%, that this active portfolio will go up 12%. If the S&P goes down 10%, your active portfolio will go down 12%. So that's when you have a beta above 1. If your beta is below 1, say 0.8, the S&P goes up 10, you would expect to go up 8. If it goes down 10, you would expect to go down 8. The one thing we'll talk about with this portfolio is that we're targeting a composite portfolio that has a beta of around 1. So we want exposures very similar to our broad benchmark, which in this international portfolio is the MSCI All Country World ex-US. So basically includes every investable country except for the United States. So we want a beta of around 1. Our beta is 0.98. So we've achieved that in this portfolio over the years. So we want that market exposure to be what we would call neutral. Alpha is simply excess portfolio returns, and then tracking error. So tracking error is the divergence between the price behavior of a portfolio and the price behavior of a benchmark. So for our portfolio, if we're at a beta of around 1, then you ask yourself, well, how do you provide alpha then? That's with our tracking error target. So we often refer to tracking error as our risk budget. So tracking error is presented as a percentage, and I think on slide 153, so I included a normal distribution. So to take everyone back to stats class for just a second. So tracking error is a returns-based statistic, and we are able in the public equity markets to get our returns generally on a monthly basis, but really these assets price every day. You could have daily price returns. But it gives us enough data points that those returns form a normal distribution, and that's what makes tracking error useful for us. So if a portfolio has a tracking error of 5% versus their benchmark, that would tell us that we should expect 68% of the time that portfolio is going to be plus or minus 5% of the benchmark return. So benchmark goes up 10, this portfolio we would expect 68% of outcomes to be plus 15 or plus 5, somewhere in that range. Then 95% probability, that represents a 2 standard deviation event. Then you take that 5, because it's 2 standard deviations, now that's 10%. You get a 10% return on the portfolio, or on the index, you would expect your portfolio to be 95% of the time to be somewhere in the range of plus 20 or 0, so plus or minus 10% of that 10%. For us, on the next slide, the tracking error range that we've targeted for this portfolio, and this is not new, this is what it's been, is 0.7 to 1.5%. So we have a conservative tracking error target for this portfolio. So again, we target a market neutral, we've been targeting a market neutral portfolio with a beta of around 1. We have a tracking error range of 0.75 to 1.5. So again, with that 10% example, say we fall somewhere in the middle of that tracking error range and it's 1%, at 95% of the time we would expect to be within 2% of the return of benchmark. So we're targeting a portfolio where we're going to have pretty high certainty that we're going to look like the asset class. And we have enough of a risk budget to have the opportunity to achieve 30 to 50 basis points of outperformance alpha. And you can see here, this is a 3-year rolling look at the tracking error for the portfolio versus the benchmark index, and it's been within that range of tracking error. One other thing I wanted to mention, because it came up as a question in the committee meeting last week, is what's a passive strategy and what's an active strategy, and that's come up a little bit today, but just to reiterate, a passive investment strategy is one that invests in the index. So it's very low fee, it gives you the index exposure exactly, and there is no opportunity for alpha there. And an active portfolio is a more traditional asset manager who is trying to beat the index, and we're paying them management fees to accomplish that. So with that, I'll step into the structure study. So looking backward a little bit, wanted to review the purpose, goals, strategy, objectives of the structure of the ex-US portfolio. So the purpose of the portfolio is to provide diversified exposure to economic growth outside the U.S., provide liquidity, and to provide significant returns commensurate with risk taken. The primary goal of the portfolio has been to outperform the benchmark by 50 basis points net of fees, so after fees paid, over longer-term time periods. The strategy of the portfolio, which I've already touched on a bit, is to construct a benchmark-neutral portfolio. So we're going to have similar style, market cap, sector, and geographic exposures to the benchmark, and that should equal around a beta of 1.0. We're going to target having a portfolio that's more heavily allocated, has a significant allocation to active managers. And I wanted to jump ahead on that point real quick. Sorry, Brent. Just to make that point, I think it's important, the active versus passive. Slide 176. So this is in the appendix, slide 176, but this is just a quick look at why in this portfolio we do target a bigger allocation to active managers. So this portfolio is about 80–85% exposed to active managers, and this is the reason why on this portfolio. When you look at the returns across these different international small cap, large cap, emerging markets, the median manager has provided alpha. So these are excess returns, net of fees, that we're looking at. Top quartile managers have provided 2 to 4.5% of alpha. Of course, if you're in the bottom quartile, you're still underperforming, so of course there's risk there. But we believe that because you can get outperformance from median and top quartile managers, that's an appropriate risk for us to take portfolio.
On page 155, you have this statement about 2016, the portfolio has not met its primary goal.
Yeah, we'll get to that in a couple of slides.
Okay.
We'll talk about the performance. So yes, it hasn't quite hit that 50 basis points, but it's been very close. So we'll get there in just a minute. So again, on the strategy, just to reiterate, the tracking error or active risk budget 0.75 to 1.5, that lines up with that overall goal of achieving 50 basis points of outperformance over longer-term time periods. The objectives, the ongoing metrics that we track, we follow these portfolios very closely. We're following the composite to make sure that we are style and market cap, sector and geographic exposures are relatively neutral. We're following the individual managers very closely to make sure they're in compliance with their stated objectives, that we don't have a large growth manager that's all of a sudden investing in small cap value, things of that nature. So we spend a lot of time in conversation and also tracking all of that data, and RBK helps us with that a lot. So I wanted to jump to slide 163, just to give you a quick historical perspective on where this portfolio has been and the structure studies that have occurred through the past. The big change came in 2015. So there was a change in statute at that time, which allowed us to increase our exposure to international equity to the target range of 20% of the total portfolio. So at that time, we shifted from a more aggressively positioned portfolio because it was underweight to one that was the market neutral strategy that you see today with a high allocation to active and some factor-based, which are also active strategies, with a smaller allocation to passive. Over the last few years, that really hasn't changed much. There's been some modest changes to the roster. There was a small cap manager, Templeton, who was taken out of the portfolio a couple of years ago. And again, here's the current roster on slide 164. This has been fairly stable over the years, which is a good thing. As long-term investors, this is what we want to see. So the average tenure of these different asset managers is about 10 years that we've been invested with them. So some of them predate the reconstruction. Some of them came in around that time. But this portfolio has been very stable over the years in terms of its exposures, and I think it's a positive. So to your question on the performance, slide 165. So since the reconstruction, the portfolio has outperformed by 29 basis points. So the goal is 50. We're at about 30 since the reconstruction. Over the last 7 years is 41 basis points, so we came up short by 9 basis points. Over the last few years, the more recent time periods, the performance has been a little bit lower. A big reason for that is when Templeton was removed from the portfolio, so that was an active small cap manager. You remember from that slide in the appendix, small cap provides the greatest opportunity for alpha. So we had a small cap manager in this portfolio that was number one, it was underperforming. We've had some key personnel changes. So the decision was made 2 or 3 years ago to remove it from the portfolio. It was replaced with a passive vehicle. So that asset class where you generally have a great opportunity to provide alpha, we were now in a passive vehicle. So it reduced our ability to generate alpha. And I believe really it was done as a short-term solution. We're heading into a new structure study. Things have gotten a bit delayed as Darla left and I've come on, but now we're back on track. So we'll be, as we get to the recommendations, you'll see that we'll be looking to take that small cap allocation and invest it in active managers. And assuming we pick good managers, which we're going to try really hard to, that can add to the alpha in the portfolio.
And sorry, Greg,
go ahead.
I just wanted to say, I mean, what he's illustrating here is, one, at 50 basis points target that's intended to be long-term, and we still view it as very achievable. We want to tie this back to the asset allocation, that beta, meaning a beta very similar to the market index. That's important. We want to make sure this is acting like international ex-US equity. And any value add in the portfolio, we want to make sure it's coming in a very efficient way. Range of outcomes to get to that 50 basis points fairly tight. We want to make sure we're not too far or above or below it. Hopefully above would be preferred. But it is something we still think is very achievable when we have a fully active manager roster at work.
2015 predates every single member of this council.
Right.
And I'm wondering at that time, what was sort of the projection of how long it would take to get
To the
50
basis points of outperformance. Gosh, I don't know that we really set a time limit.
Well, and I can tell you too that at the 2020 structure study, it had achieved the 50 basis points. So in that first 5 years, it had achieved more than 50 basis points of outperformance.
Good to know.
And then the last few years, because of some of those headwinds, slightly below. I thought this slide too was a good one to talk about fees. So I don't have a specific slide in here on fees, but as we come back in the future with strategy manager recommendations, that will be a slide that you'll see in here, what the fees are that we're paying, how that compares to, you know, if we're replacing managers, what that does to the overall fee structure of the total portfolio. So this total portfolio fees are, I believe, 32 basis points. So for our passive strategies, we pay 4 or 5 basis points, something like that, generally speaking, because they're passive, there's no active management. For our active managers in the portfolio, we pay generally between 40 and 60 basis points. And because of our scale, the way it works at these public asset managers is there's tiers of fees, and the more assets you bring, get into the highest tier. We're in the highest tier, I believe, for all of our active managers. So we're paying the lowest possible fees at the active managers that we're using, the lowest fees that they offer. And so that's, and you see that in the net and gross performance. So I've got the gross outperformance and the net outperformance. So the net includes those fees. So the public equity markets, it's obviously very straightforward in terms of what fees are. We don't have any performance-based fees. So we're more of we're the plain vanilla asset class. So the fees are pretty straightforward. With that, I wanted to jump to slide 171 and just review our recommendations. So our overarching recommendation is to maintain the overall strategy, the overall portfolio composition, and risk budget. We do have a few recommendations around the structure of our roster of investments. So our first recommendation is to transition our passive investments from a World ex-US index to an all-country World ex-US index passive vehicle. So the World ex-US is everything except for the U.S., but it doesn't include emerging markets. So the U.S., the ACWI ex-US, all-country world, does include emerging markets. And that all-country world ex-US is our overarching composite benchmark. So by moving from the world ex-US to the all-country world ex-US, it more closely aligns us with our benchmark and helps us achieve that market-neutral strategy a little bit easier. If you wanted to.
It really is a portfolio construction device to make sure we're aligned as close as we can be through policy benchmark. It had been the World ex-US developed only ex-US benchmark, and that was to allow for a little more control over the emerging markets. What the strategies you have access to now and review in the future for the portfolio, those managers will consider both developed and emerging markets actively. So they will be controlling more of that allocation. That's why it was the way it was, but we're moving to something that is more aligned with your policy benchmark.
We're also recommending expanding that mid-cap portfolio. So as I mentioned, our small and mid-cap exposure is mostly in a passive vehicle. There is a manager in there who's an all-cap manager, so we get some mid-cap and maybe a little bit of small-cap exposure from them. But what we're going to look to do is to expand that sleeve of the portfolio to include active value, active growth, perhaps an active core. Because of our size, we think it makes sense to, instead of having 1 or 2 small-cap managers, to have 3 or 4, so that we're spreading those assets out across more managers, because that'll also open up the managers available to us to invest in some ways. So there's liquidity constraints for small and mid-cap asset managers. So if we're giving one small-cap manager $500 million, but their capacity for their portfolio is really $2 or $3 billion, we can be a constraint on what they're able to do. But we don't want to be that constraint, and we'd like to be able to invest in some small mid-cap managers who have assets under management that aren't quite so big. Because as they get bigger, it constrains their flexibility on what they can invest in, and we've seen that can constrain alpha. So by taking smaller chunks, giving it to more managers, I feel like it'll give us a better opportunity to generate alpha for the portfolio. We'll be taking a close look at replacements for some of the managers in the portfolio who have underperformed or experienced significant changes to key personnel. There's two in particular where lead portfolio managers have left or very recently are in the process of leaving, and that in conjunction with some underperformance, we're taking a close look at that. So there's a very good chance that over the coming months, we'll come to you with a recommendation of, we recommend leaving this manager and moving into this one, and here's the reasons why.
So it's like a Templeton-like situation.
Templeton-like situation, yep, exactly. But again, really, I think the overarching message here is that the structure is sound. It's working. It's giving us the exposure that we want. We feel like we can make some adjustments to the roster that will give us a better opportunity to achieve that 50 basis points in the future. And the next steps, assuming the structure study gets approved, next steps would then be the due diligence process. So we'll be going through a screening of the universe, RFP process, a long process of basically collecting all of this information, including DEI information. So that'll be something that's included in the RFP. So we have a series of questions that we ask and data that we'll collect in terms of what the makeup of their investment team, what their diversity, equity, inclusion policy is at their firm. And it'll be one of those components of our decision-making process. So, these processes are very, it's partly quantitatively driven and partly qualitatively driven. So as we're assessing an organization, their process and philosophy, their firm culture, those DEI factors will come into play there. Because we do think it's important. In a similar way to, as you look at a firm, I think we have a bias towards investing with firms where they're mostly employee-owned. And in a similar way, I think we're going to be more interested in investing in firms where they have a clear DEI policy, they have diversity on their investment team, things of that nature. So as we bring manager recommendations, we will have that information in the packet. And then, we'll be conducting interviews, on-site due diligence. So this process will take a couple of months, but as we work through the summer and into the fall, I think what you'll probably most likely see from us is that we'll come back with, we won't present everything to you all at once probably. We'll probably come back with, here's our recommendations for the small cap part of the portfolio. Here's our recommendations for the large cap part of the portfolio, et cetera, emerging markets. Maybe do this in 2 or 3 steps, so it's digestible for you, and so we're not making, and really what you can expect is there's not going to be major changes here. Structure is essentially staying the same, with some changes to the roster. So that's our recommendation. Any questions? Yes.
This was a great presentation. You should also be a teacher. Okay, so let's go back to page 155.
Mm-hmm.
So I think there's a lot of really good information on that page.
Right.
So to the chairwoman's point on the second paragraph, we're mentioning primary goal to outperform its benchmark by 50 basis points. So I guess before I even go into the weeds, overall, our percentage you said about, what, $20 billion more or less that we're looking at that is in this group?
No, it's, somewhere around 7 or 8 billion. It's 20% of the total portfolio.
Which portfolio are you talking about? Because I'm looking
Of
at
the,
policies.
of the 52 billion, this is
7 billion?
70 billion.
Because I just looked at early childhood land grant and severance. We're at 20, 20, 20. They're the second highest just in those three funds. So you're saying it's 7 billion of that we're looking at in total.
Yeah, the target allocation for international equity is 20%.
And then the small cap versus large cap, what's the breakdown on that?
Small cap is, it's about 15% of this portfolio is small cap. So it's in that passive vehicle, but then it's also some of our strategy managers have small cap exposure. When you think about our emerging markets managers, they're going to have small cap within their portfolio. Neuberger Berman's an all cap strategy, that's got small cap exposure. So there's, RBK puts out this great quarterly performance analysis. And so that's where we are able to take a look at that small cap exposure, sector exposure, geographic exposure of the total portfolio.
So when we're looking at 15% small cap versus 5% large cap, also wanting to change that.
So it'd be 15% of 20%.
Okay.
So
Oh,
more like
yeah.
4 to 5%
Yeah.
of the overall. And it's going to be more market dependent in a way because we don't want to take a large bet on large cap or small cap. It's going to be market neutral to a degree. So what we want to do is be more active within small cap and not necessarily overweight small cap.
Yeah, so it comes back to that market neutral strategy, means that our exposure within international is very similar to the overall makeup of the market. So we aren't going to be overweight or underweight small cap. We're going to be generally pretty closely equal weight to the broad international equity market.
Let's go to benchmarks. You mentioned you want to switch passive investment benchmark to ACWI. It's on a different page, 22 of 23 developed countries. You mentioned emerging markets. The emerging markets part of the current benchmark or of the benchmark that you're wanting to switch into?
So we're not looking, so the benchmark for the total portfolio, we're not recommending changing. It's a little confusing, right? But so the benchmark for the total portfolio is the MSCI All Country World Index ex-US. That includes developed and emerging markets. Emerging markets are generally about 15 to 20% of that benchmark. So that benchmark is your broadest kind of view of international equity.
That stays the same.
That stays the same. So that's the benchmark. So then we invest in an index fund. That right now, that index fund is the MSCI World ex-US, which doesn't include emerging markets. So what we're proposing we do is take that World ex-US exposure and put it into the All Country World ex-US exposure, which will match our benchmark exactly. So our benchmark stays the same. We want to match our passive vehicle to our benchmark. Yeah. And it's confusing because interchangeably we use.
And that's why. So that's the connector I needed.
Yeah, interchangeably we use like benchmark and index, and sometimes in different contexts, so it gets confusing.
So within the index, we have emerging markets, and the emerging markets is within the U.S. All countries, the one that's 22 and 23 developed countries.
Yes. So one of the changes that our recommendation will make will be part of our emerging markets exposure is going to move into passive, the passive exposure. And we talked about this at the committee meeting a little bit. So it may increase our passive exposure by 2-3% of this portfolio and reduce some of our active risk in emerging markets. But honestly, we won't really know exactly until we've identified the managers that we're going to recommend, and we put it into an efficient frontier, and we allocate across those managers in the most efficient way possible, and there'll be some tweaks in there, but that'll come in future presentations.
So let's go to active and passive. So you said the passive, I missed the first part of your sentence. What was the percentage of change that you were trying to do for passive, more or less?
It's 2 or 3% increase in our passive exposure, so we're still going to be really in that 80 to 85% of the portfolio is going to be in active managers, as it has been.
So the portion that you add into the passive will go from a 40 to 60 basis point cost to a 4 or 5 basis point cost.
Yeah, that small piece, so it might have, that 32 basis points, it might have the effect of taking us down to 31 and a half. But
everything is helpful.
And I think too, as as we bring new managers in, obviously part of that process is negotiating the best possible fees for ourselves.
You want to go into that part, but the next part on that page 155, managers, which will populate this new structure, will be identified through a comprehensive public RFP. I want to know a little bit more about what that RFP process looks like, because I know we do the RFP process for like contractors, like Mercer, Townsend, and others, but I haven't heard of the RFP process happening within, and I'm curious about it a little bit.
Yeah, I'll let.
Do you mind me taking that?
Yeah, Matt's done this. This is my first time. I've been on the other side of the RFP process, but this is my first time doing this, and Matt's done this a million times. So.
And we've done it a few times for the public market asset classes here at SIC. What it does is it provides a signal to the investment management universe across our investment management universe that these are the types of strategies we want. That's a very clear purpose, and this is the asset class. This is the type of strategy we're looking for, and here are some hurdles you have to go through, something like a 5-year track record, or some low asset hurdles, like you need to have $500 million in strategy before we're going to look at it within this process. But that's intended to just be more of a signal to the investment universe that broadly we want you to see what's out there. And what will happen is, one, that will be a public document that we want everybody here, that will be able to see the MQ, the minimum qualifications, and all the other information used. It will include a questionnaire, ask for a lot of information and data from the managers, and it will be published through RBK. Will reach out to a very wide set of managers with no hurdles attached to this notification. And hey, this is out there, you should look at it. You have something that's compelling, back and submit. And it'll also be picked up by various publications out there that are subscribed to by other managers, that just make sure that it is seen by everybody possible. And what will happen is we'll have a lot of interest in these. So I wouldn't be surprised if we get 40 to 60 responses back. We'll go through a process of looking through quantitative information, but also qualitative information to try to narrow that down to a list that we feel we should interview more closely during an initial stage of kind of semifinalist interviews. That they're very consistent performers, have the cultures that should allow for continuous improvement and continuous success, and that we want to get to know better. And from there, we'll go into a even finer, smaller list of who do we want to go visit and really decide want to put money to work with them. And throughout that process, it's never perfectly linear, meaning we'll come up with information we'll offer the managers along the way that we'll request during the process. So it's very broad, very comprehensive, and intended to really capture as much as you can for any given asset class.
And when you think about the universe of potential managers that we can use, so think about small cap international growth. There's probably 150 that are in the universe, and we're able to see this. So we subscribe to a service called eVestment, as do RBK, and all institutional managers basically submit their return information, their holdings information, et cetera, into this database. So we're able to look and screen and see who all the available managers are. And then through this process, it's also publicized in a way which is very standard across the industry. So everyone every potential manager out there has the opportunity to respond to the RFP.
And I think that's my point I was trying to get at, is I want to make sure the RFP maybe goes through the governance committee or somebody to say some of the things that we would like to see in the parameters of what we're expecting from those fund managers. You mentioned DEI, I know there's an ESG policy that SIC has. Currently, how many managers do we have, and how many of them are, quote, not performing as?
Yeah, so you can see for public equity, it's a little different than private equity, right? Private equity, they generally have an IRR target. They have hurdle rates to be able to earn their performance fees, things of that nature. In public equity, what you're really looking at is a manager has a mandate for large cap growth. Our benchmark is the large cap growth benchmark. Our goal is to outperform that benchmark over 3, 5, 7-year periods by, generally it's going to be 2 to 4%. But some are more aggressive, some are less aggressive. So, you know, you can see in the monthly performance, we've got each manager listed, and then they're each compared to their benchmark. So in the case of, you know, for one that's not meeting the requirement, the William Blair Emerging Markets, you can see that over the last 5 years, or 3-year annualized, they're negative 11%, and the benchmark's negative 6%. So they've underperformed by 5% a year. So that's a problem. That's one of the ones we'll be looking at and probably recommending a replacement for. But then we've got other managers who, over longer term time periods, have provided outperformance, and some that are in a close enough range that it doesn't necessarily constitute a change at this point, unless we feel like there's been a change to key personnel or a change to process philosophy that we think is an issue. So that's how we track it. That's how you guys can track it. And we're always happy to address questions there as you look at this and say, hey, why are you guys releasing this manager? They haven't achieved their targets.
On the 3 bolded areas, I would just show those to the council. They're pretty important. I appreciate those we have, especially the second one. When it comes to the RFP process, I think we have a lot of opportunity to be able to really be diversified and allow people who have done a really good job but maybe haven't been in the field for a long period of time to really help outperform where we're trying to get. I know that opportunity stands. I wanted to just ask, I think that's it. Okay, thank you. Further questions on this? Hearing none, we've got a motion, I believe.
Madam Chair, based on the recommendation of the Council Investment Committee, consultants RBK and SIC staff, I move that the State Investment Council authorize an asset allocation study for international equity as discussed by the Council and memorialized in today's meeting.
I'll second the motion. Got a motion by the Secretary, a second by Madam Treasurer. Any discussion on the motion before the Council? If no discussion, we'll take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summers.
Yes.
9 in the affirmative, motion passes.
Great. And Director Dunn, before you leave, I just wanted to really compliment you on clear explanations and answers to questions and sort of even anticipating questions that you were going to get. So I hope that continues throughout this process that you're about to undertake. I mean, it's a large job ahead of you, so good luck.
Yeah, thank you.
All right, now we're going to move into our investment votes. We've got, I believe, 4 of those. Remind folks that the presentations should be brief, and our managers are on primarily for questions. If they'd like to make some broad, general remarks, that's fine, but, you know, I would like to hold the time for council member questions, really. Okay? All right, so with that, we're going to kick it off with Director Lofton and Makita on Strategic Value Capital Solutions, agenda item 3F.
Thank you, Madam Chair. So, note to self, never follow Fred Dunn.
Yeah. Take him to lunch.
I believe we're on,
sorry.
What's that? Okay. I believe we're on page 187. As you mentioned, it's item 3F on the agenda. I have with me Sharon Bates from Makita to co-present, and online we have Michael Hewitt, Sarah Schaefer, and Ryan Ford from Strategic Value Partners to answer questions. So this is another opportunity where we've gone back, found a fund that the council originally approved a commitment to their market period, and their asset gathering period is still open. So we're using this opportunity to add on and top up, whatever you want to call it. The additional amount that we're recommending be committed to the strategy is $150 million. That would double the total commitment to $300 million for Strategic Value Partners. The original commitment recommendation is included in your materials. Even though this is an add-on, I want to point out that Makita underwrote this investment as a brand new investment. So they sort of went the extra mile on their due diligence and on the investment side as well as the operational side. Those materials are also in your packet. And just then really quickly, we continue to build out the portfolio in terms of strategy, geography, manager, diversification. And then finally, this is the second fund in the strategy, and it's built to capture a fairly broad spectrum of opportunities in distressed situations that often require industry and operating experience on the part of the manager. So with that said, I'm going to turn it over to
Great, thanks so much, Bob. I'm going to keep my comments very brief as this is an existing investment within the SIC program. We are looking to increase the recommendation of Tom is to increase your exposure to it. So as a brief reminder, this fund targets a net IRR of 13 to 15% with net 1.75 multiple on invested capital. They do that by focusing on corporate stressed and distressed across liquid event-driven tradable opportunities, private debt restructurings, and control-oriented transactions in both North America as well as Western Europe. It also has the flexibility to invest in opportunities in aviation, real estate, and power restructurings. The focus is on the middle market, which the manager defines as companies having an enterprise value of less than $1.5 billion in enterprise value. The focus is on asset-heavy industries and companies with predictable cash flows and low technology risks. So think older technology companies. Generally speaking, this portfolio is built by purchasing existing loans in the secondary market rather than predominantly originating loans, which is two different ways to execute the strategy in this space. So as I typically do, I'll quickly walk through strengths and concerns or considerations as it relates to the strategy. So why do we like it? Visibility into the existing portfolio. As mentioned, you're already an existing investor in this portfolio or in this fund. The manager has invested over $900 million, and performance is in line with the expectation of the fund of 13 to 15% net. Again, early in the investment period for the strategy, so we think that was very nice. So we like its flexibility, as I've already articulated. We also like its geographic flexibility. We expect approximately half of this fund to be in opportunities outside of the United States, with a focus predominantly on mainland Europe. In terms of considerations, things that we would bring to your attention, we have gotten comfortable with all of these, and we'll also identify the mitigants that we've addressed, but we always think it's important to draw potential concerns with any investment that we bring to the council. We would highlight that this portfolio has had higher volatility than many of other strategies in the like sector. Why we're comfortable with this is that where that volatility and where those historical losses have been in, they've been in strategies and sectors including shipping and oil and gas companies and assets. And so on a go-forward basis, the manager is not investing in those sectors. So that's the mitigant from our perspective. The problem areas will be avoided on a go-forward basis as communicated by the manager. We would highlight from concern perspective that Victor Kosola, who is the founder and the CIO of the firm, does have a very large economic interest in the firm and has not widely distributed equity. Would highlight from a mitigant perspective that he has largely reinvested his carry into the firm and is not, so he's reinvested into the firm and is also actively in the process of increasing the number of participating stakeholders on a go forward basis. We further highlight that the team that's responsible for the cap solutions piece of this portfolio is relatively new at the firm, joining in 2002. So not the long history associated with your broader experience with this team, but a robust track record at their former firm of Beachwood Capital, and certainly 2+ years of history. It's also going to be a relatively small percentage of the portfolio. So with that, I'm happy to take questions or happy to have the manager address any concerns you may have. All right, we're going to go to questions from council. Madam Chair, is this same fee structure as the original amount?
Oh, actually, no, we are getting an additional fee reduction.
The fee structure is the thing, you just hit a different tier, so you're eligible for a lower fee.
Nothing
On the full amount or just on the full amount? Motion.
Make a motion, Madam Chair. Based on the recommendations of the Council Investment Committee, Consultant Makita, SIC staff, and general fiduciary oversight of RBK, move that the State Investment Council approve a follow-on commitment of up to $150 million to Strategic Value Capital Solutions Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Okay, we've got a motion by Member Bingaman, and second by the Treasurer and Member Allen. Any discussion on the motion before the Council? Seeing and hearing none, a roll call vote on the motion to do a top-up of $150 million to Value Capital Solutions.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
UFA Secretary Wayne Props. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Chris Summer.
Yes.
9 in the affirmative. Motion passes.
Great, thank you so much. Thank you. Brief. All right, Director Sable. All right, agenda item 3G, Carlisle Realty Partners. And Director Sable, you understand the instructions?
I do.
Morning, Chair. A big day for real estate asset class today. We'll be making commitments, requesting commitments of up to $550 million across diversified collection of opportunistic managers. Reporting today from Townsend, our Seth Marcus, and Rob Coaches, and we have representatives of Carlisle, JD, and Westport Capital Partners here with us today. First investment on the agenda is a re-up recommendation for $300 million to Carlisle Realty Partners 10. The content for in the diligence book is on page 263, manager presentation beginning on page 297. Manager representatives here today are Chip Lippman, partner and managing director of U.S. Real Estate, and Roman Boss, partner and MD on investor relations. We've had 3 prior commitments to Carlisle funds in the real estate category. 2 of those have been $100 million commitments in prior vintages in this fund series, CRP 8 and 9. We also have a $100 million commitment to the open-ended Core Plus Carlisle Property Investors portfolio. Broadly speaking, in terms of investment approach, the GP manages by employing a mix of greenfield development, renovation, and redevelopment strategies to capitalize on opportunities in property types that are advantaged by demographic and/or technological tailwinds. Examples in the current environment include multifamily, industrial, active adult, apartments, and single-family rentals. In terms of prior fund performance, the series has been extremely strong. Since the 2001 vintage, which was CRP 3, series has consistently generated first or second quartile performance. The vintage 8, in which we have the $100 million investment mentioned previously, has generated a mid-teens IRR with a portfolio mark as of 9/30/23. CRP 9 is nearing the end of its investment period, has no meaningful return available to date. What we like about the portfolio series: strong and consistent track record, conservative use of leverage. Sponsor has extremely good alignment with LPs with a strong co-investment. And then separately, I've mentioned that I think it's broadly covered in the media that housing of all stripes is in short supply in the market. This development-focused strategy is focused on residential markets that are broadly undersupplied. If you look at funds 8 and 9, they've built over 80,000 housing units to date. With that, I'll turn it over to Townsend for any quick comments.
Just a real brief comment. So when we think about, like comment all 3 managers real quickly, that Carlisle is by far the most diversified, the largest fund you're going to see out of these. And for that reason, it's also the largest community that we're recommending. It provides a more diversified strategy, a more diversified exposure, and with that comes, just more exposure to the property types that keep it mentioned. So if we think about what property types are attractive today, demographic-driven property types, industrial, multifamily, single-family rental, self-storage, active development. This is the strategy that Carlisle looks at. You'll see that similar demographic-driven trends out of the other 2 managers, but this one being more diversified. When we think about portfolio construction, our portfolio has a mixture of very diversified private equity names like Carlisle, Ares, Blackstone, and others. And then we augment our exposure with more direct, more targeted strategies, which we see on the next managers. So from a portfolio construction standpoint, we're really excited about these 3 managers all being in front of you today. It just happened to work out that this is what works for everybody. But regardless, this is from a fundraising perspective, from a portfolio construction standpoint. These all are very additive features to the overall.
So we do appreciate you all being here in person with us. Just like 2 minutes of just very brief.
Yes.
Okay.
Yes. We'll keep it very brief for sure. On the team, piggybacking on what Seth mentioned, these funds are very diversified. Each of our portfolios have north of 300 investments in them, and to be able to execute on that strategy, we need a large team. So this team executing on this strategy, the largest investment team at Carlisle. We have 130 investment professionals solely dedicated to deploying this capital that we're asking you to re-up. And not only it's a large team, but also a very stable team. Chip has been with the firm leading that group for 26 years, and that's really important in real estate being such a cyclical asset class. The last comment I'll make on my side, DEI is very important, diversity. and we have about 45% of our team being minority-focused, and so women, minorities, and other ethnicities. Carlyle, as a firm, actually starting in 2013, was one of the first groups to focus on diversity. So we're really happy about that and proud about that fact. Maybe touch on a couple of highlights.
Yeah, very briefly. Biggest team at Carlyle with 135 people. Joan mentioned, we think of ourselves being an operator, being a single asset, finding individual situations where we have proper value margins, where we have, we're talking about deep and growing demand pools, tight range of outcomes on our deals where we have consistent performance. Deliver that in Fund 8. We're really excited about where we stand there. By the way, excited for your support in prior funds. As we look at the market today, you mentioned housing shortage is still, by our calculations, about 2 million units. So we're looking forward to delivering new units into what are, we think, going to be increasingly undersupplied markets, especially in 2026 and 27. Capital markets have stopped development. A number of our markets that we're seeing population growth in places like Nashville and Austin that are extremely strong in their growth prospects. The other thing that's interesting about this vintage is that for the first time in 6 or 8 years, we had a chance to buy into broken capital structures. We've already done so multiple times in Fund 9, and we're buying at 60-70% of replacement cost because of leverage issues that existing owners may have in assets that we really like. So just very simply, we love the fundamentals we're seeing ahead with stoppage in development, increasing vacancy rates in our demographic-based themes, and we're going to get a chance to buy at discounts along with our development-related strategies. And so in great shape. The last comment I'll make is we focus on delivering capital back. We're approaching 100% capital back already in Fund 8 on a net basis to our investors at a high rate of return. And importantly, as we track our frameworks, we've stayed out of office, hotel, and retail for quite some time. We wouldn't expect there to be any in this fund either. We need to focus on about 80% in our demographic residential themes, 20% industrial.
Now we're going to start the questions with Member O'Donnell.
Hi.
Hi, how are you?
I have just a few questions about the residential component of your portfolios. As I'm sure you're aware, number one, New Mexico is an exemplar, particularly Santa Fe, of the housing crisis and the fact that low and moderate income people simply can't afford to buy homes. When I hear demographic-driven strategy in residential housing, I get a little concerned because the demographic that I'm aware of is that demographic, the demographic of moderate income families who can no longer afford to buy homes and are being forced to become lifetime renters. And the role of investors in that shift in the housing market is obviously one that's subject to debate. But what I'd like to hear, number one, is Albuquerque one of your 30 metros? And number two, I'm very interested in the single-family rentals and where they're coming from, whether they're new development, and how your what looks like acquisition rehab or something like that strategy rolls in there.
Thanks for those questions. On the residential, the housing shortage is front and center strategy. And it's, as you look at the options, and on the one side, we focused on the millennials, and they're facing a challenge where they don't have the net worth that prior generations had. Cost of occupancy and ownership, right now, by our calculations, about $1,200 a month higher cost of renting. And so now something that we're focused on there is mainly in this strategy delivering new supply into markets that are lacking supply, and also focusing importantly on areas where the rent to income ratios can be low. And as an investor, we're trying to find that, because I think that's the deepest possible pocket of demand, give us that narrow range of outcomes. So we've avoided more luxury situations, trying to get situations across the Sun Belt where our rents might be $1,600 a month or $1,800 a month, where that represents low 20% of income or 25% of income for our tenants. And we're constantly avoiding really that ceiling on rent at the higher end. But to that point, we've been extremely excited about, and we've talked about in the context of ESG, delivering those types of units into undersupplied markets, which is important to talk to some places with most active officers in Charlotte, around Atlanta, those types of places, and helpful. Similar common supply multifamily, where attainable product. We've been much more interested in the last few years, developing basic, surface park, no garages, 3-story multifamily that appeals to that widest swath of demand. It's probably seeing the greatest shortage of supply. And then we do have a little bit here in Albuquerque. And on the other side of our demographic barbell, we focused on what's called active adult, which is apartments for 70-year-olds, and we have a couple projects here.
So none of the projects you have currently in New Mexico target that lower and moderate income demographic of renters. You're looking more at active adults and seniors.
So far, yes. So far, yes. But we're always looking at population movements. I would say that here's talk about our activities being on nodes on a grid, where sectors on one axis and geographies on another. We're always looking for the deepest and strongest growing pools of demand. And I would say so that with respect to Albuquerque, it showed up on our list with respect to seniors. I think it's possible population movement to apply generally to investment.
I noticed you mentioned Charlotte and Atlanta, and that of course is a little alarming to me too, because as you know, I believe both of those cities have been profiled fairly recently in terms of the role that institutional investor purchases have played in driving the home prices in certain low and moderate income neighborhoods through the roof. So that's of concern to me, because those are two sort of exemplar cities where people who have lived there for generations can no longer afford to buy a home. And if you look at the percent of residential housing that's being purchased by institutional investors, it's upwards of 30%. And the same can be said of Albuquerque. So this one is of concern.
Just one, if I make one more comment. In those places, though, especially in this strategy we're developing, I would argue we're providing an outlet for supply. So, I think too specific, but we're in Charlotte. We just approved some investments just west of town, where we're delivering about 250 new units at that low rent that are attractive to that moderate income. Similar comments apply to Atlanta. Outside, we tend to be in the outlet of growth. Outside Atlanta, but providing supply to what's a shortage.
Some of the pricing pressure that you're mentioning is probably more focused on the middle to higher end, high-rise concrete construction, and we haven't been active in that part of the market at all to just.
And the acquisition, I imagine you were, what percentage acquisition versus rental?
I would say that in this fund, in single-family rental and multifamily, will be heavily oriented toward development, and just because of the returns we're seeking.
Can you quantify heavily?
Heavily.
I could just say, so in Fund 89, you were 90%.
90%.
Yeah. So, similar strategy.
But there could be interesting, to Chip's point, with stress capital structure, there could be interesting acquisition opportunities. Very surgical, have to have the right underlying real estate in there, but there could be some opportunity.
And that'll be mid-range multifamily.
Again, when you start talking surgical, you start talking pinpointing specific neighborhoods, and when a lot of investment activity is targeting a specific neighborhood, you can have some really profound negative effects on the residents. So again, that concept of targeting specific vulnerable would be obviously not the term that you use, but specific opportunity neighborhoods is again something that I'd like to sort of keep an eye on.
All right. We've got, are you finished?
Yes,
Okay, we've got number Alice.
This question on the industrial part, are you investing at all in data centers or in self-storage, both of which are high growth areas?
Great, yeah, thank you. So we'll have, I would say, in our past funds in Fund 89, we're about 3% self-storage. I expect a similar targeted approach there, especially in some of the markets like South Florida, Southern California, New York, where there's a limit to amount of inventory. We have had a practice in data center. We've been, in my entire time at Carlisle, I've been involved in data center since the late 90s. Had a company that we took public and sold fully in 2021 into Foresight. Since then, we've been careful in data center. Our view has been that yes, demand has returned, but there's quite a bit of capital chasing it. We don't feel we're getting properly compensated generally in terms of yield for the risk that's present in data center. As it relates to industrial, we're developing generally bulk industrial with what they call 36-foot clear heights, new age industrial that allows for two really basic nodes of demand, e-commerce related demand, which everyone talked about, but then also
growing sense are coming out of obsolete product and moving into that new age, more efficient type of building. And an adjunct to that is we are acquiring sites that intentionally that are adjacent to data center development. And that's giving us two options. We have an example in Fund 8, where, in fact, we started industrial development that had the right power, wasn't zoned for data center, but then we were approached by data center buyers and are going to have a 4X multiple and exercising effectively that option to give that person the chance to build a new data center on our site. The other byproduct of that is, if we can find those sites adjacent to ongoing data center, is that we're insulated from pure industrial supply in those places. So we're in Northern Virginia, Atlanta, and some of those situations. So that's a strategy. I would say that with respect to data center, generally just have a sense that it's overfollowed and have not like the high basis that's required for us to invest in it. And even at the longer term, we've been worried about obsolescence. So it's just a risk tolerance that's been outside our realm of comfort so far.
Thank you. To Member O'Donnell's point, when you guys are building, are you also looking at or working with different programs to have a percentage of AMI for particular linear development?
It'll depend on the jurisdiction. But yes, there'll be cases, you know, we've had quite a bit of that activity in New York City, as an example, but then it'll be governed by the local jurisdiction. And then I would say across our portfolio generally, we'll engage with city council, county commissioners, and others to explain the business plan, make sure that we're thoughtful in our approach and measure with respect to our rents. And so that, but an opportunity there is to have, in a lot of markets, some component of our units that we deliver be governed by percent or, in some cases, 8% of AMI, something like that.
So I'm on the mortgage finance authority as well, and we work with different programs or different groups that also are very respectful of a certain percentage of the rental of the home being a percentage of AMI, to be able to help those people who might be stuck in a predicament that it's a little bit more difficult to house. So I just wanted to point that out to the rest of the council, because whether or not we like it, people are going to purchase homes and property, and for you to be able to go into that business knowing it very well and being able to contribute back to the community that has the need is still really important to me. I want to get into page 263. We talked about everything very quickly, Keith, and I think that was a great rundown, but we didn't really go into the fees, and I just want to understand two concepts. This is on the public side. The performance, it says, of CRP 9, which was $100 million, is nearing the end of its investment period and has no realization date and consequently no meaningful performance. What does that mean? Does that mean we lost money, we stayed the same, we're waiting?
It's too early to find out.
Okay. And then the summary mentions something else that I don't quite understand. In your guys' world, consequence of this is a double layer of fees that causes gross to net spreads to be wider than the firms that do not. Firms with the increase in scale of our investments will pay lower fees than in the prior years before offsetting. I think the prior year's offsetting is the tier that I'm looking at on the confidential doc on page 276. If you could just tell me if that goes to the 1, 2, 3, the last tier.
Get a lower fee because of a larger commitment.
Perfect. That's what I wanted to know. Thank you very much. Further questions? Conclusion question?
Sure, I'll be happy to do that.
Okay.
Based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $300 million to Carlisle Realty Partners 10 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, we've got a proper motion by Member Bingaman, second by Member Allen. Discussion on the motion before the council. No discussion. Oh, yes. Okay, we're going to take a roll call vote on agenda item C. That is a $300 million investment in Carlisle.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Dwayne Props.
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
None in the affirmative, motion passes.
Much appreciate your support.
All right, next we're going to, 3H, J Brett.
So I'll kill the dead air here for a moment. The next two investments that we have will both be opportunistic strategies with relatively high return targets. This one will be in the mid-teens. They're targeting nichier subsectors of the real estate market that would generally be considered other. So these would be in the other as defined by NACRE, or they would be subsectors within the traditional types. So this will be JDM Real Estate Fund 2, managed by JDM Capital. Today we're joined by Jarrett Cohen, managing partner, Aman Kapadia, partner. Thank you. Dan, out there, he was told there's no share for him. Fair enough. So the manager focuses on opportunities present in niche segments that are characterized by undercapitalization and inefficient operations within those segments. These segments tend to comprise not yet institutionalized property types or subtypes within traditional market segments. Categories that would fit this definition include industrial outdoor storage. That'll sound like Altera, the investment we brought a couple of months ago. Land lease communities, commercial self-storage, or something like hangar real estate, aircraft parking, and FBO operations. Manager has a relatively limited performance history under this name. The first vintage of the fund, though, has been a first quartile performer, both in terms of IRR and multiple of capital. What we like about the manager is focuses on these niche segments where low competition coupled with expected institutionalization of those segments offers the prospect of high returns going forward. The value drivers in these segments tend to have low correlations with traditional real estate. Therefore, these will be beneficial to the fund from a diversification perspective. And then finally, these strategies are driven by optimizing land value rather than dealing with the additional complexity of managing complicated businesses. With that, I'll hand off. I think, Rob, you were going to make comments?
I'll make some comments on this, and without trying to duplicate what Keith said, stepping back, big picture, in institutional real estate, portfolios like yours have invested in four major property types. So you've got office buildings, retail centers, industrial, an apartment, or some sort of residential strategy. And what we're seeing over the long term is a shift towards more of the other nichier categories. And what that is capital is moving into these smaller sectors that are more fragmented, they're less developed, and there's been perhaps an early mover advantage by going into some of these sectors. And JDM has selected a number of these sectors to focus upon, and they've developed a pretty good track record in their relatively short existence. The firm spun out of another money manager back in 2017, 2018. So it's a smaller, growing firm. They've got basically one fund under their belt that's been raised and invested. That fund to date has delivered performance, to go to the treasurer's question from earlier today, has delivered performance above their original target. And although it's still relatively early, it's still a number of years to play out in that strategy. There is also, we've been able to aggregate some capital. Townsend has backed this group, both in its prior fund and in this category, and we have a number of investors interested in this, and to the extent that we can combine your capital with some of our other client capital, the managers offered a significant fee rate that will both cut the management fee as well as the promoted interest.
This is our first relationship with them, right?
Yes, your first relationship. So the recommendation is $100 million to JDM Capital, and with that, I'll turn it over to JDM.
For brief remarks.
I will be 50. I'm Jared Collins, managing partner with JDM.
I'm Kapadia. I'm a partner at JDM and a partner at Jarrett.
So we are a 25-person firm. Everyone is exclusively focused on our real estate strategy. And we invest in platforms and special situations, and as Keith and Rob said, primarily in alternative types of real estate sectors. And while our firm is relatively young, we've been doing this for the past 15 years, including at my predecessor firm, where Alvin and I were partners. Townsend first partnered with us 13 years ago, so we know each other well, and they were able to beat us up on fees. Now today, as I mentioned, alternatives in the private market are primarily complementary to a lot of folks' existing strategies. In the future, we expect them to be a much bigger part of institutional portfolios the same way that's happened in the public markets. And the ones that will become appreciated are those that have really good fundamentals and those that are scalable. And so our approach is to look for those that have those potential qualities that are overlooked. So a few things we like, and I'll jump into some examples. So we like things that grow faster than the traditional sectors. We like things that are less dependent on the macro economy, less dependent on interest rates. We like things where there are barriers to entry, as Keith said, primarily from a land position. And critically, we target things that generate much higher unlevered yields. The commercial real estate market right now, even though the 10-year Treasury is at 4.6%, yields on commercial real estate are in the low fives. Stuff we target is approaching 10% plus. That's what we've done in our first fund. And in a world of high interest rates, we believe you need to generate much higher unlevered yields in order to generate any kind of performance. Okay. So I'm going to give a few examples of some deals. I will be brief. So what we plan to pursue, one big theme is commercial self-storage. 2021, we noticed that the Amazons of the world were gobbling up all the industrial real estate. The biggest users were getting their hands on everything they could. And this was displacing a lot of the smaller tenants. What were those smaller tenants doing? They were taking retail storefronts. They were moving into self-storage facilities, which are not at all designed as a workspace. In many cases, it's illegal work. So we created a company to provide work and storage space for small businesses. And we do that by converting distressed office buildings, distressed big box retail, of which there's a lot, or flawed industrial assets. We chop up the spaces into small warehouse units that average about 600 square feet. We have amenities, kitchen, lounges, conference rooms, loading dock doors, things like that. And we've done exceptionally well with it. We've been stabilizing at 12% plus unlevered yields. This is right in the middle of traditional self-storage, small warehouses. The hole in the market has been overlooked. Each facility has about 100 tenants, small businesses. And they fill up quickly, and they're happy. And we know this because they tell us and they don't go back. So our plan is to grow this from the 11 locations we currently have, 30 locations over the next 2 or 3 years. Seeing similar dynamics in lots of different sectors, like even cold storage, where a lot of developers, big companies in this space, they accommodate the larger users, but not the smaller ones. There's a hole in the market with that kind of use. You'll notice a lot of our themes have a storage or logistics component. Big theme for us that Keith mentioned is industrial outdoor storage, which I recognize you have some familiarity with. What we do is we buy zoning restricted properties that accommodate shipping containers, equipment rental, and the huge shortage of truck parking we have in this country. Since we've had this warehouse boom over the last 10 years as a result of e-commerce. What that means is you've got lots more goods, making more stops, and more trucks. Those trucks need places to park, but nobody likes building truck parking facilities in their neighborhoods. And municipalities hate it, residents hate it. And so there's a major shortage of these things. Big supply-demand mismatch. We're actually looking at a truck terminal in Albuquerque right now. Dan joined us. If you're interested in hearing about that deal, he can come. Now, we love this strategy because there are lots of different demand drivers. Now, these are which are infrastructure projects. Yet zoning critically restricts how much of this stuff you can make, particularly in good locations. We're targeting 10% plus unlevered yields in this strategy. And we think it is a better business than traditional warehouse investing. CapEx is lower and supply is lower. And those are the two killers of real estate fundamentals. Touch on one more. On the other end of the storage spectrum, we have a strategy focused on aircraft hangars. The number of private jets in this country keeps growing, and planes keep getting bigger. It requires more hangars, but there's very little available land on airports, and it's highly regulated. It's extremely difficult to build one. So, by acquiring or occasionally developing modern hangars, we benefit from this kind of mismatch. Also, we have a captive tenant and sell fuel to. So think about this like a warehouse with a gas station attached. And if they want to rent space in your warehouse, they got to buy from your gas station. We have deals in our pipeline that we project to generate over 15% unlevered yields on cost. So this is the kind of thing we do. We have many more we can talk about, but we'll be quick. So we think this is a wonderful time for our strategy. Yields are really high. There's not a lot of competition. Many of our competition's hurt. Many real estate investors are going to be going out of business with high rates of risk. And lastly, the institutional interest level in the platforms we create continues to grow. So we're extremely excited about the opportunity we have, and thank you for your time. Under 5 minutes? All right, thank you. Let's see, based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $100 million to JD and Real Estate Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, we've got a motion by Member Bingaman, second by Member Allen. Question on the motion. I'm looking for the roll call.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Props. Yes. Nick Taya. Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
Yes.
8 in the affirmative, motion passes.
Thank you all so much. Take care.
All right, finally, we're going to go into agenda item 3I, Westport, Control 3.
So, Madam Chair, this will be the last voting item for me for this month. We're bringing a recommendation that SIC commit up to $150 million in West Point Capital Partners Cold 3 LP. This is a new relationship for the SIC. Content for the presentation is on page 370 in your board books, and the manager's deck begins on page 417. Joining me from Westport Capital, today, Jordan Sokaransky, Principal, Peter Aronson, Principal, and Angie Nagler, MD of Investor Relations. About the GP, Westport Capital was founded in 2005 by a group of 7 principals who average 14 years of real estate-related experience. Westport specializes in opportunistic and value-oriented investing. The group began its foray into cold storage by establishing the New Cold platform in 2012. Since that time, New Cold has built 14 cold storage warehouses across 7 countries and has become the 4th largest provider globally. The mission of New Cold 3 is to develop an established pipeline of locations that will more than double the size of the business over the course of the life of the fund. Next couple of comments I'll make will refer to some of the introductory remarks that Member Bingaman had made. This is going to be a somewhat unique ownership structure in that the fund will own a stake in the New Cold holding company that owns both the real estate assets and the technology companies that have provided the infrastructure to make these warehouses work. A part of the capital raised will recapitalize some prior investors. I think there was some concern at the outset that this was going to be a zero-sum proposition where we were going to take over an entire investment from some other group of investors. I think a more appropriate way to look at this is when the company was started in 2012, the technology was unproven and they didn't have a warehouse. And so I think we could look at that situation as more a venture capital-oriented analog. The people who would invest in that were investing very much in a startup proposition, and their expectations for return on capital would be different, right? You go from a venture stage investment to a growth stage investment, for example. And that's essentially what's going on with New Cold. They've proven the concept at this point, and we're joining a number of other LPs who are committing growth capital to provide the source of capital to enable them to develop their business plan going forward. A couple of other considerations, probably first and foremost, is that the GP's carry from the earlier investments is being rolled into this investment. And so management is still at risk in the same way that they would have been before, but at a higher dollar amount than they would have been before. I could go on and on about the facility, but I think I'll let the management team discuss that. Real quickly, what we like about this opportunity is it's an impressive, highly disruptive product in the marketplace with good product market fit. They have a fully identified development pipeline that they will execute on. Unit economics of the individual warehouses are quite compelling. We have a skilled team with a demonstrated ability to execute against that growth plan. And then finally, this opportunity offers actually the highest net return IRR available in the opportunistic space that I've seen to date. With that, I will hand over to Seth for a quick comment.
Sure, I'll be brief as well. So as mentioned, he is a new manager and dedicated single property types, so cold storage opportunity. Very contrast to what we just approved with Carlisle and JD, and we talked about portfolio construction in my earlier comments. So this is again going to a dedicated property type. This is our first dedicated cold storage exposure as well, but it's the second that we've identified a while ago, just looking for the right partner, the right opportunity, the right entry point. We believe this is the right one here. So why cold storage? And I'm sure that the West Point can go into this, but and we all have to know this, but the demand drivers are extremely robust. The global cold storage market has really seen an increase in demand for perishable food items and also biologic drug products among the consumers. This includes that e-grocery component that really took off during COVID. Additionally, the sector's benefited from changes in fulfillment, automation, industry consolidation, and expansion of really organized retail food industries, grocers, across grocers and manufacturers. So previously, we lived in a just-in-time model, and now supply chains are creating the redundancies that we need to from the COVID environment where we meet consumer demands as they peak. These are just some of the driving factors behind cold storage. And on the demand side, there's really been a lack of new supply, I should say, in cold storage facilities. The old model is extremely inefficient, cost inefficient, and then retrofitting or redoing any of those is not efficient from a cost perspective. So that's a cold storage that New Cold is building is the state-of-the-art new facilities that are in high demand. So they provide really a highly automated facility that reduces really some of the cost of energy. Lastly, and never reason to make an investment, but we also negotiated attractive fees for down to clients based on clients' similar to the G.
So what's the total fundraise goal for? Okay. And so the way I understood you to explain it is there's this technology. You all own the company that made the technology?
That's correct. So
And the Fund 1 and 2 were part of that same, the
development of the technology?
Correct. So maybe just to characterize it this way, we manage a series of funds and accounts that sit on top of a holding company. Holding company owns all of our warehouses, our development business, and our technology subsidiary companies that service the warehouses. So if you're effectively making an investment in the holding company structure, and you're going to have exposure to the existing assets, the technology, and the growth that's in front of us. And I just would say that of the $2.5 billion we're raising, $2 billion is going to an active specified development pipeline. About $500 million we believe will go to recapitalize some existing members, as Keith described, that need liquidity at this time. But I would just be remiss if I didn't mention that of those that are taking liquidity, about 90% of them are actually bringing new funds into Fund 3. We've had tremendous support from existing investors to continue with the growth, and we've delivered very excellent returns over the last 12 years. And as Keith said, we have really great risk-adjusted return opportunity that continues to be in front of us.
I'm sorry, I didn't mean to interrupt.
I was all set.
Okay, so then if you all just want to make just some cursory remarks.
I think that was...
It's a question, because a lot of the countries that the building this in are European. What about ESG requirements? What are you doing to meet those?
So, great question, and one of the reasons why large producers gravitate to our solution is, first, we have a very low carbon footprint. If you look at a cold store, a typical manual cold store has a very large footprint and a big roof area. And that's
I'm going to direct everyone to page 423. You could see a manual facility on the left, and then a new cold facility on the right.
So a cold store loses energy when it has a very large footprint. We build 150 feet tall. We have very narrow aisles because we don't have forklift operators going up and down each aisle. All of the product storage and handling is done with conveyors and cranes. So we have really no open or dead airspace that we need to cool. So we're very efficient with energy. Another big part of our solution is we're a large consolidator of volume in a given region, and so we really take trucks off the road. Our warehouses could replace 10 or 20 warehouses in a given market. And so prior to consolidating in one of our locations, producers have trucks going across multiple warehouses. And so by really taking mileage off the road, there's a significant ESG consideration. Also, when you consolidate inventory in one location, you have better food safety, better food quality, better cold integrity. Right now, food producers lose about 10% of their inventory each year scattered across multiple warehouses. So we really rationalize supply chains for our producers, and that's why our growth is non-speculative. We're pulled to locations where producers need the most help transitioning from a legacy supply chain to a new sustainable solution. And we use a third of the energy of a typical warehouse, and we're very efficient in how we use labor, and the labor in our warehouses are actually more skilled type of jobs, and we take people that historically have worked on forklifts and we make them systems operators, and so it's a better work environment for people that have to typically work in a freezer. So there's an integrated ESG benefit in addition to the cost savings that we could do for a customer.
So I cut you off a little bit in giving your, any kind of remarks you want to give, but answering questions actually is probably the best way to introduce yourself.
Yeah, we always jump right into it. Don't be asked anything. I will say that what's unique about what we do is it's non-speculative. Before we put a shovel in the ground, we have at least half the warehouse committed for the long term. Over the past 12 years, we've steadily built for between a 9 and 11% unleveraged return on costs, call it a 9 to 11 cap rate, and we do it with contracts with industry-leading multinational high-credit producers on very long-term agreements. And the customers guarantee their storage in the warehouse, and so we have very predictable cash flow streams. And these are really long-life free cash flow generating assets that we've created. And now we have a $3 billion immediate pipeline, which is mostly repeat customer-driven growth. And I think that's the best validation for our business, for multinational producers that again really. I'll also mention that we're warehousing food. People need to eat every day. We've proven that this business model works in any economic environment, or interest rate environment, Inflation actually has been really good for our business because we do get escalators in our contracts. But what's more noteworthy is the manual providers have had to raise their rates to unsustainable levels such that a producer says, if I'm going to pay that rate, I might as well go into an automated environment where I have more sustainability. And that's candidly why we have such an opportunity in front of us.
Any other questions? Madam Chair. Yes.
So you mentioned carbon footprint, and that facility there looks a lot more efficient than the one on the other side. But I'm interested in the breakdown of the fuels used for the electricity that powers the.
Great question. So we typically will secure from power grid about 11 megawatts of power, but we actually only use about 3 megawatts. We also have tremendous redundancy where we have generators and batteries. And in Europe, we're so advanced with alternatives that in the coming years, about 50% of our energy is coming from off the grid. And that's really our goal across markets. We started in Europe, but we will bring that know-how to the U.S. in the coming years as well.
Are you familiar with the fuel mix in the electricity that's being generated that you're currently taking up? You got clearly facilities are in a lot of different places. Power, obviously the power that flows to the grid in those places coming from a variety of different sources. Have you done any analysis of what that fuels breakdown ultimately is?
And by region, I could tell you that today in Europe, in many markets, there's even a nitrogen ban. We can't even use diesel-powered energy sources, even for construction. So green hydrogen is now prevalent in many of the markets that we're in. Natural gas, I think, is most dominant. In the U.S., it really depends on the region. And so I don't have a specific statistic, but I could tell you that the impact we have is up and down the supply chain. When you look at a producer, 80% of their cost is really in the storage and handling of the product, and 80% of that is really trucks on the road. And so I can't emphasize enough that that's where we take significant energy and fuel off the road. Is producers are constantly sending trucks from warehouse to warehouse, and we take significant mileage away. Many of our customers are saving tens of millions of dollars a year in transport by consolidating. And what we also do is we try and locate a warehouse in the path of delivery. So we're the first link post-production. We consolidate all the volumes, then more efficiently manage the forwarding to them. About 85% of what leaves our warehouse goes to the large retail DC. Our warehouses are really stocking the retail outlets in the market.
I'm sure. Could you, on the technology, are you leveraging third-party warehouse management software, or did you write your own, or how does the software side of it work?
So like Keith had said, early on it was venture capital. We started by buying a WMS company. So we have our own warehouse management software. We have our own material workflow control system, which is the software that drives all the automation in the warehouse environment. And over time, as our pipelines grew, we became more and more vertically integrated, such that we really control the lion's share of the equipment that goes into the warehouse. We are our own systems integrator. We're not reliant on third parties for software, hardware, or implementation. As a result, we could build these warehouses at a price that's more attractive than other market alternatives because we're not reliant on third parties. We can also maintain the systems with integrity better than being reliant on third parties. These are truly mission-critical warehouses, and we've built a vertical integration solution that has made us a very strong counterparty against the market-leading food.
Further questions?
Madam Chair, I have a question. Could you explain to us how you manage the currency risk, because a lot of your product is overseas?
Great question. So we do a few things. First, we are building around the world, and we're sending European equipment around the world, and so we're always hedging that cost to fix a development budget. Then, from a capitalization perspective, we're always borrowing in a local currency, and then any equity that leaves the fund is also hedged through currency options. And so we always are protecting the notional value of the equity across the various funds with hedges, and we, on a quarterly basis, will manage those hedges. As the value of the business increases, we increase the notional value of the hedges. And our hedging costs are fully factored into the net returns that we've underwritten, and the goal is not to speculate on currency.
Thank you.
Further questions? Seeing none, do we have a motion?
Sure. Based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $150 million to WCP New Cold 3 LP, subject to and contingent upon New Mexico legal requirements, Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay. Okay, we've got a motion by Member Bingham, second by Member Allen. Any discussion on the motion before the council? Hearing none, if you could do a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary William Probst.
Yes.
Nick Hayes. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Bert Summer.
Yes.
State in the affirmative. Motion passed.
We really appreciate you all being here to answer questions. Thank you.
Thanks for the opportunity.
Thanks
for the partnership. Thank you.
All right, Mr. Schiff, what do you have for us? You have percentages. Yay, nice five.
All right. All right. Good. That was actually my first point. I'll try to be super quick with my comments, Madam Chair. You will, as Treasurer Montoya noted, you will note on the budget schedule summary, I think it's on page 443, I added a percentage calculation on the far right-hand side of the column. I have been working on that, but finalized it this month. And if you have any questions, please let me know. As I typically say in these meetings, we're not anticipating any budget problems through the end of the fiscal year. I also have included the investment holdings report for March. Just remember, within that report, you'll notice that the March report, as it falls on a quarter end, is a lot thicker than a typical month would be. The quarter end reports include not only monthly roll forwards on all the permanent funds, all the clients. You'll also see, in addition to the monthly roll forward, a quarterly roll forward. So that's the reason for the thickness of the report. If there's ever any questions that you have, please feel free to reach out to me. And then lastly, I have provided the preliminary budget for fiscal year 25. I believe it's on page 523. And I just wanted to give just a little bit of background for our newest members, if I may. Typically, our budget request goes in at the end of September. It's actually an appropriation request. That appropriation request gets recommendations by both the LFC and the executive branch. Typically, the lower of those two recommendations, I think it was the LFC recommendation, is selected. That is what typically goes before the legislature and is approved. So what I'm doing is I'm taking the feedback that we've gotten on our recommendation as approved by the legislature and basically putting forth a budget that kind of aligns that budget with the appropriation that has been approved. It's very stable. Typically, most of the dollars that are spent within our budget is within that 300 category. We've found in the past that the LFC and others are a little stickier with giving us additional budget dollars as it relates to personnel, but we're working on filling some vacant positions, and as we do that going forward, we think we're probably going to get a better reception at increasing those budget dollars in the 200 category.
What's your current vacancy rate?
It's probably over 20% relative to 31, but I have to say John has a pretty laser focus on getting positions filled, which I really appreciate, and we're focused on that, but be aware that as people retire or move on or whatever the situation legislation is, it kind of opens up, pockets that we have to go back and fill. So we take a couple steps forward and then maybe a couple steps back, but I think we're headed in the right direction. Other than that, I'm open to any questions that you might have.
So, I'm so excited. So if you go to his, especially on board for the council, especially people who aren't as excited about budgets, he puts the percentages for each one of those categories, and then the overall percentage is 17%. So when we look at it, like today, there's 10 months in the year, so we should be at 17%, and we're on target of 17%. So that's the little cheat sheet of being able to see it, at face value instead of having to recalculate everything. So thank you very much for doing that. It's easier for me, and I appreciate that.
Sure, my pleasure. That's all I have, Madam Chair. Thank you.
All right, so we've got agenda items here about a vote to enter into executive session. We are going to need a motion to do so. But before we take that motion, I'm wondering if you could increase the size of our participants. Is that possible to, yeah, there you go. Okay, because I need to be able to see who's on. Who is the person on the telephone?
The person ending in 423 on your phone, who is this?
Not exactly sure. It's a local number.
Madam Chair, talking to our IT team, I believe their proposal would be to essentially lock the meeting and move anyone who is not a council member into a waiting room. Just that we could then move them back out of the waiting room into the meeting when we exit the.
All right, that's all I wanted to know. Okay, so I will take a motion.
Madam Chair, pursuant to New Mexico's Open Meeting Act, NMSA 1978, Chapter 10, Article 15, in accordance with the New Mexico Attorney General's current Open Meetings Act compliance guide, I move that by a majority vote of quorum of the State Investment Council, the vote of each individual member to be reflected in the minutes, the council enter a closed session solely for limited discussion of a limited personnel matter exemption, specifically relating to the compensation matters and State Investment Officer John Clark. Only the previously specified limited personnel matters in this executive session.
All right, we've got a motion by Member Sanchez, second by the Secretary, and yes.
To clarify, is this about the compensation for SIC staff? Is that what that means?
Yes, addressed to specifically State Investment Officer John Clark.
So it's the compensation for Anthony Johnson.
Okay.
Madam Chair, I just wanted to note, we do have a limited attendance here, 7 members here, I think maybe 8 on the phone, maybe 9. The governor's not here, so I personally happy to have the discussion, but I think in terms of taking any action, I would suggest we wait until perhaps the May meeting, in hopes of getting the governor and other members who may want to participate.
So do you object to going into executive session?
No.
You do not.
I share the same sentiment, and I also didn't realize we were going to talk about this month, and I just how it got on the agenda, or how we get agenda.
Madam Treasurer, this was a directive from the council to us at the end of the last meeting, was to put this on the agenda for this meeting.
Thank you.
All right, any further discussion on the motion? Can we take a roll call vote?
We have a second on that?
Yeah, we had a second by the Secretary.
Okay, I didn't hear it, I'm sorry. Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Props.
Yes.
Nick Diaz.
Yes.
Is it yes? Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
It's 9 in the affirmative.
All right, so let's let IT do their thing first before we begin. Everyone, not